Sunita. Have we got Sunita yet? I'm looking. I don't see Sunita. Howard, are you here?
Yep, I'm here, Drew.
Ashvar, are you here?
I'm here.
Nick?
Good morning.
Muyo's here. Dick, are you here? Santos?
Yes.
You're here, Dick. Tim? Vince. I see Vince is here. I'll make a note that we currently have the position. Oh, Sunita's here now. I just saw her come on. The active police rep seat is vacant and will be filled in August. Let's see. Next up. No closed session today, right, Roberto?
That is correct, Drew.
Oh, great, thanks. All right, so let me switch over to orders of the day. So all votes, let's see, I'll just read them off. All votes are called to be roll call votes. Try to stay on mute if you're not speaking, just to cut the background noise. We're gonna have some pretty consequential discussions today. And when we have those, I'll go ahead, we'll have a presentation like the one we're gonna have from Chiron. And then I'll go round robin so everybody has a chance to comment. And we'll open the floor up to our staff and to the city, because these are pretty consequential debates. You two, Harvey and our consultants. And then we will do a roll call vote. In general, I'll try to signal when something is consequential, and we're going to go round robin. Otherwise, I think just go ahead and interrupt the speaker if you have any questions, even for the consequential ones. If you have a question, go ahead and do that. Let's see, we have no sunshine that needs to be waived today. So that takes us through the orders of the day. So I sent out an email reminding everybody, hey guys, this is going to be a really long board meeting. That's often true of the June meetings because, of course, we don't have a board meeting in July because of the holiday. So the August and June meetings tend to be long. This meeting is exceptionally long because there are two temporal things happening that'll show up. One is the departure of our good friend, Dr. Susan Tierman. And the other one is, of course, the pension obligation bonds that the city has had a task force that we and our staff are members of. We're getting our first real in-depth look from our actuaries on that. And that presentation by Chiron probably will be one of, I read it, I think it's one of the most consequential things. I've been on the board for 10 years, one of the most consequential things I've seen in my tenure on the board. So we're going to take our time. This meeting may go to 1 or 2, but these are important items, and we're really going to take our time to do them right. Having said that, let's go ahead and kick this off. Anybody want to pull anything from the consent calendar? Okay, if not, I'll entertain a motion to approve the consent calendar.
So move, Santos.
A motion by Santos, do I have a second?
Second by Gardner.
Gardner will second. We have a motion by Santos, second by Gardner to approve the, it's going to be one of those. Thank you, Dick. Consent calendar. We're going around the room to vote. Andrew, how do you vote?
Aye.
Anita.
Aye.
Howard.
Yes.
Ishvar.
Aye.
Muyo.
Aye.
Santos.
Yes.
Panzeri.
Aye.
And I am Chair Lanza. I vote aye. Prabhu, over to you for investments, and I'll get my video fired up.
Thank you, Mr. Chairman. Good morning, trustees. We have present performance overview for the first quarter that Makita will be going over, and also the fourth quarter private equity performance review by Neuberger. But before that, I'd like to share a couple of things with the board. One good news and one not so good news. First, the good news, our performance continues to be strong. The pension fund was up 92 basis points in May. And as of June 1st, the fiscal year-to-date performance was a positive 23.24%. And for the healthcare trust, In May, the healthcare trust was up 1.07%, and fiscal year to date, it was up 23.45%. Of course, this comes with the usual caveats that these are estimates and unaudited numbers. And of course, we have 19 trading days left in the fiscal year if you exclude today, and anything can happen in the markets. If you remember the last bear market, it only took 12 trading days to lose 20% value. But barring anything unforeseen, we should be better than, we should do better than our discount rate. Also, it is with great sadness that I have to report to the board that Brian Starr is leaving the investment team. For personal reasons, Brian has decided to relocate to Europe. Brian has been working for the plans for 7 years. He's been an integral part of our team throughout this time. He has been a big part of our transition to a more professional approach to managing our pension assets. And in the 3+ years that I have been here, Brian has been a close confidant and trusted partner in managing our pension assets. Among his various talents, I'd like to point out Brian's exceptional work ethic, which is second to none. He'd never hesitate to pick up the phone, even if I called him at 8 in the evening, and he would spend an hour talking about investment issues. We'll miss his sharp intellect, his dedication to our pensioners, and his work ethic. The city of San Jose will lose a dedicated employee in Brian, but we are grateful for his 7 years. Brian has graciously agreed to stay on till the end of August as we search for his replacement. So please join me in wishing Brian the very best in his future endeavors.
Thank you, Prabhu. And on behalf of the board, Brian, let me just say you've been a real joy to work with. You've got a wonderful sense of humor, and I agree with Prabhu. Everything we've ever asked you to do, or anything we've ever asked of you, you've done. So safe travels, and let us know when you're on your way back.
Thank you. Obviously, a very, very difficult decision. Fantastic team to work with, and you know, sometimes you just have to make the tough life decisions because life calls. But I'm very grateful for the opportunity that I've had to work for the plans and the city, and have every confidence in the team that they'll keep the excellent performance we've generated over the last few years.
Thank you, Brian.
Congratulations, Brian. Thank you for everything you've done.
Brian Dick Santos, thank you for your service and dedication to the police and fire retirement. Thank you very much.
Thank you,
comment
Trustee.
on Brian's incredible dedication. He's probably one of the longest standing members of the investment staff, and went through the transition from one CIO to another, really grew into the position. It's been a huge, huge asset to our plan. I wish you the best of luck, Brian.
Yeah, thank you, Brian. We've had many conversations, and you know, you've always been outstanding in terms of willing to talk at any time and provide all the information we need. All the best.
Yeah, thank you, Brian. This is Howard. I in the short time I've gotten to know you, been very, very helpful. You're a sharp guy, and best of luck in where you go next. Thank you.
Brian, Brian, I want to thank you for the last 7 years. You've been actually a wealth of knowledge and help to this plan. We are going to sorely miss you. Best of luck with your next endeavor, and keep in touch. Thank you again for everything.
Last but not the least, I know we haven't interacted much, but I'm sure Prabhu's going to have big shoes to fill. So good luck with your next move. But happy to have interacted with you and gotten to know you.
Thank you, Trustee Sunita. Big shoes indeed, and we will be looking for his replacement. And Brian, of course, will participate in the search as he's agreed to stay on till the end of August. Thank you, trustees, for your kind words. Thank you, Brian. And unless there are questions, Mr. Chairman, I'd like to move on to the presentation of the private equity report by Neuberger.
Great.
Over to Brian and Neuberger. Thank you.
So we have Doug Manor on the line, I believe. He'll be presenting the fourth quarter of 2020 private equity performance report. Normally it would be Casey. She had a conflict. She'll be back. She's not going away. And we've interacted with Doug very regularly over the last few years. The board hasn't perhaps had the pleasure of meeting him yet, so this is a great opportunity to introduce him as well.
Terrific.
Doug,
Thank you, Brian. And hopefully everyone can hear me okay. First and foremost, it's a pleasure to meet all of you. As Brian said, I've interacted with Brian and Dinesh and other members of the investment team quite a bit. I'm also based in our Dallas office where Casey is, and I've been with our business since 2006, and I'm currently a principal on the investment team, leading up our diligence and coverage efforts, both for primary fund investments as well as co-investments. And look forward to providing a quick update. I know that you have a long agenda, so I will do my best to be brief and leave a little bit of time for any questions or comments. So Brian, if there we go. So on page 2, I'll keep most of my comments focused on the police and fire private equity strategic partnership that we manage. Clearly, as you've seen in the presentation in the past, we'll show the combined performance along with the legacy portfolios. Many of those legacy portfolios, particularly older ones, that performance is more set in stone. It won't move too much from quarter to quarter. There are some newer legacy investments which are performing well and a little bit younger and will be more impactful in terms of quarter over quarter changes. But as far as the SJPF private equity strategic partnership that we manage, I'm excited to report that the fourth quarter was outstanding performance, really across the board. We saw, significant rebound in private equity valuations after the initial onset of COVID in the first quarter last year and early second quarter. And, across the industry, we saw good performance, but excited to say, I think even better performance than the overall industry within your portfolio. In the middle column there on page 2 at the bottom, the key takeaway is at this point, we're at a 1.4x net multiple. So for every dollar that's been invested, currently has a total value of about $1.40. And the net IRR has increased considerably as of Q3, which you'll see later. That was around 17%. The IRR as of the fourth quarter has increased to 24.6% on a net basis. So that's, just from a quarter over quarter perspective, about 14% increase from Q3 to Q4. Brian, if you want to flip through the next 2 slides, I won't spend much time on the ones that he went through. Happy to answer any questions about those. But on page 7, you'll see just an update on where we stand. This will look pretty similar to what you've seen in the past quarters. On the left side of the page is focused on the SJPF strategic partnership that we manage. The donuts or pie graphs on the far left are based on the capital that we've committed to investments. And since much of the committed capital for co-invest and secondaries goes in at the outset of the investment or early in the life, the invested capital, which are the donuts in the middle, you'll see a much heavier weighting towards co-investments and secondaries. The primary, as that capital is invested typically over a 3 to 5 year period, will increase. So on a committed basis, it's roughly almost 3/4 focused on primaries and 28% co-invest in secondaries, but almost 50-50 from an invested capital standpoint. And excited to report, as I'm sure Casey has in the past, that those co-invest and secondaries have generated very strong early performance in the first 4 years of the program. But primaries as well have generally avoided the J curve, been able to take advantage of what's been a good, robust market overall. So really across primaries, co-invest and secondaries, really strong performance. And from a geographic standpoint, it is a heavily focused on North America, but there is significant exposure, about 20% across Europe and the rest of the world. So Brian, to the next page. So here I'll spend just a little bit of time. This is where, excitedly, the performance is, was already good. It got even better as of Q4. On the top half of the page, you can see the breakdown between those different investment types that I just referenced, and the secondaries with really strong IRRs and TVPI out of the gate. But importantly, the primaries, which make up the bulk of the committed capital, have really performed well in the last year and now generating a gross return of nearly 29% with a gross TVPI of 1.35. On the bottom side of the page, this is where you can see that quarter over quarter change. So the net multiple for the portfolio increased from 1.23 to 1.4, which was, as I said, about a 14% increase quarter over quarter, and a significant increase in the net IRR. Unfortunately, the fund of funds index is still not available as of Q4. So we've shown the quartiling as of Q3. Remains to be seen if we'll move. We're just kind of right on that first or second quartile threshold as of Q3. We'll see if we bump over it into first quartile as of Q4. And also very good news to report. We, in the last couple of weeks, have been receiving the Q1 valuations. We don't yet have, the final report, but I can tell you that just based on all the valuations that have come in for Q1, going to be perhaps Q4. We'll see about a 15% increase in net value from Q4 to Q1. So hopefully when you see Casey for the next quarter, you'll see even stronger performance as of Q1. With that, Brian, we can go to the final set of slides. And obviously, won't go through these slides. It's quite busy with the detailed schedule, but it does walk through each and every single investment. And the good news is those investments that have been in the portfolio for 2 to 3 years are performing well. And even those that are a little bit younger, their performance is not as meaningful, but they have performed generally pretty well out of the gate. So only have a handful of investments that are kind of still in the J curve or showing negative performance. So overall, quite pleased and excited to see some really strong momentum. I'll end by saying that the really strong performance that you're going to see in Q1 was driven by one co-investment in particular. It operates it has automated storage and retrieval systems, which have been in strong demand, in the post-COVID environment, given all the investment that's going into warehouses and logistics and delivery systems. And that was a co-investment which increased in value from about a 1.5x to about a 6x, and saw a new investor acquire about 40% of the company at that new valuation. So that led to a very, very significant increase in the valuation, and is one of the strongest performing investments in the whole portfolio. So with that, I will pause for any questions or comments.
This is Howard. Thank you, Doug, for the report. I just have one question. You mentioned primaries, and I saw in the NB numbers, the NAV went up to like 171 from like 140 something. Was that driven by primaries, and was that only PE valuations that led to the rise?
Yes, and Brian, if you want to go back to page 2. Howard, are you referring to the 171.7 here?
Right.
Yes.
And then in the prior quarter was like 140 something. So the NAV popped up, and you mentioned PE and primaries. Is that where it occurred?
Yes, the increase in NAV is driven by 2 factors. All of the investments are in private equity. The primary versus co-invest versus secondary is just kind of the means by which it gets invested, either for co-invest directly into companies, or primaries and secondaries through funds. But that, you're right in that that increase to 170, 1.7 is driven both by capital calls and new investments that are made. So just additional dollars in the ground, but then also driven by the changes in value. And we saw about a 14% increase in the value of the dollars already invested in the fourth quarter. So there's really two main factors driving that.
Okay. All right. Thank you.
My pleasure.
Good. Jump in if anybody has any questions. Floor's open. Back to you, Prabhu.
All right, thank you, Doug. And Mr. Chairman, with your permission, I'd like to turn this over to Makita for items 2C, 2D, and 2E. And of course, feel free to stop us at any time for questions. Over to Laura and Jared.
Thanks, Prabhu. Good morning, everybody. I'm going to share my screen here. First, we can talk about the private markets plan as of the fourth quarter. So, this is a public version of the report. More information is provided to staff. And similar to Neuberger Berman, this is as of 12/31, so the typical lag of a few months here. So page 2, if you can see this snapshot, summary of each account type. The far two right columns have your IRR compared to a public market equivalent. Just to expand on that, is basically to take real estate as an example. We take the cash flows that have actually been happening with your real estate investments, and we just apply those in a hypothetical scenario to a public index that tracks real estate to see what the comparison would be. And as you can see down these two columns, the comparison is quite favorable for the pension plan versus public markets. I would also note that for private debt, where you can see the comparison isn't as favorable, if you isolate the investments that only current staff has made, that 5.5 IRR is 8.8%. So it goes up quite a bit if you exclude some of the older vintage year investments. If you go to page 3, we can talk about private debt. This program is a decade old and mature in the sense of being overweight the target. So it's at 4.5% current weight versus a 3% target. It's also mature in the sense, if you look at the bottom left, the contributed dollar amount is very close to the committed dollar amount. And I would also note, as discussed before, that the performance is being affected by some, in particular, some 2013 vintage year funds, which I know we've talked about in the past, dragging down the program a little bit. If you go to page 6, you can see cash and return details of several of the plans, of several of the investments here. Many funds committed to by current staff have done well, most notably Arbor Lane with an IRR close to 18% here. Page 7 shows vintage year diversification. So that is a goal of the plan. And you can see in these top 2 pie charts that has been achieved quite nicely so far. Page 8 gets into real assets. So we're almost up to about half of the target weight, but an asset class with a lot of attention on it at the moment, especially as inflation is more and more part of the dialogue. A solid IRR close to 8% here at the bottom and ahead of peers. Sorry, on page 9, you can see the program is still ramping up. So the dollars being contributed to managers is quite a bit more than the dollars being distributed from managers. On page 11, we get into the specific investments line by line. There's been several commitments in the past couple of years, as you can see, but none of them have meaningful performance track record yet. And still half of the total commitment was made in 2016. And you can see those funds are doing quite well. The top one from Brookfield in particular, with a 13.4% IRR so far. Go to page 13, we can talk about real estate for a minute. So this is near the target of 3% target, a 3.3% actual weight. You can see this program is still building here on page 14, again, where contributions have been outpacing distributions. And on page 16, we get to the fund by fund line. There's several funds here. I won't highlight anything in particular, except that at the very bottom, that 11.2% IRR is quite strong just on an absolute terms to be, into double digits like that. And then finally, moving on to page 18 is venture capital, the newest program, which is still very new, certainly. It has grown in size since the third quarter, but has a ways to go to reaching the 4% policy target. Performance is not yet meaningful. And on page 21, you can see the 3 investments that make this up this category so far. With Canvas there being a new addition since the third quarter report. So the rest of the report is market overview slides of various private markets, but in the interest of time, I thought I'd stop there and see if anyone has any questions.
Go ahead and jump in, folks.
I have a quick question. Of the private debt portfolio, is a large part of it floating versus fixed?
Yeah, so would you mind going back to that slide, please? And I'll kind of talk through how the various strategies respond to that. So the vast majority, actually probably half of the managers listed here would be classified as special situations or stress and distress, not necessarily distress for control. But I think from a risk perspective, there's not a significant amount of interest rate risk. It's much more credit risk centric, with some positive convexity coming from those lower entry points. The vast majority of the newly originated loans across these portfolios are done on a floating rate basis. But I would classify almost all of the investments in the private debt portfolio to be non-investment grade. So they do have a significant credit risk component. The interest rate risk component is very low.
So would you think about this portfolio as a good inflation hedge? With certainly inflation being the topic du jour, so to speak.
My personal point of view is that in an inflationary environment, credit's not a particularly great investment because the principal value erosion could potentially dwarf the just the floating rate component of the interest. But certainly this would perform better than, say, a long duration fixed rate bond portfolio.
Fair point, yeah. Thank you.
Other questions? Back to you, Prabhu.
Thank you, Mr. Chairman. Jared, do you want to continue on with the presentation of the calendar 1?
Sure.
First quarter performance. Thank you.
Yeah, thank you. And Laura is going to present this part.
Hello, good morning, everybody. I hope you're all well. Can everyone hear me okay? Okay, great. So we're pleased to present another strong quarter of performance for your plan. If you take a look at page 4 of our report, just to sort of set the stage in terms of market performance in the public markets, you can see that risk assets were strong during the first quarter of 2021. The Russell 2000 index, which is small cap US equity, was up almost 13% in the 3-month period, followed by real estate and investment trusts, commodities, which were up almost 7%. And then the broad US equity market was up a little over 6%. If you look at developed non-US stocks, the MSCI EFA index, they were up 3.5%, emerging markets up 2.3%, and high yield bonds up just under 1%. We did see a rising interest rate environment, which leads to typically negative returns for bonds. So the 10-year Treasury bond yield was only 1% in late January. By the end of March, it jumped up to 1.74%. So as that rose, you saw some negative returns for bonds. You see TIPS, Treasury inflation protected securities, were down 1.5%. Investment grade bonds, the Bloomberg Barclays aggregate was down 3.4%, and emerging markets bonds down 6.7%. That situation has reversed a bit in the second quarter to date period. We now stand at about 1.62%. And so the Barclays aggregate bond index is up over 1%. since this report was produced, but you will see some negative returns for bonds in the first quarter. If you take a look at the next slide, I would just point out some of the longer term returns, some of the trends we've talked about in the past. If you recall, growth really dominated value within equities for a really long time. And that still persists for the long term. But if we look at recent time periods, we see value outperforming growth, which sort of for us reinforces the value of diversification. A lot of folks would say that, if you like everything in your portfolio at the same time, it's probably not diversified enough. I think we've sort of hated some of the value managers for a little while just because growth has been so dominant. But if you take a look at the Russell 2000 value at the bottom of that first section, it was up 21.2% in the first quarter relative to 4.9 for Russell 2000 growth. On the large cap side for the Russell 1000, you see value up 11.3 relative to growth at 0.9. So it's been a good thing recently to have value in your portfolio. Value does need to come back a lot more to sort of reach parity with growth, but it's good to be diversified. I'll, in the interest of time, move ahead to your specific portfolio. Let's see here. Yes, so if we take a look at, perfect, thank you, Jared. If we take a look at your total market value, it stood at $4.5 billion as of the end of March. You can see the current allocation relative to policy, and it's quite close, especially with the overlay. If we take a look, flipping ahead, we have your traditional slides on watch list and other updates, but I'll take a look at performance here. You can see very strong performance. If you look at the total fund relative to the policy benchmark, you see outperformance across most trailing time periods, with the exception of the 10-year. If we take a look at the fiscal year to date period, the total fund up 19% as of the end of March, with 1 quarter in the fiscal year to go, up over 30% for the 1-year period. And that's, if you recall, the first quarter of 2020 was when we had the major pandemic related correction. And now that quarter is going to be falling off of your 1-year numbers, or has fallen off. So you see very strong numbers here. I think what's interesting is if you look at the 1-year return for the peer group, it's 31.7. So you can see that there was a lot of risk in the peer group as well, and a lot of equity, but your fund has kept up quite well with lower risk than the peer group. Really, if we look across, pretty much all major asset classes, you see outperformance relative to benchmarks. I'll highlight, we want to skip ahead here to a couple of individual managers. I'd move ahead to page 34. Some of the returns for the 1-year period are just kind of mind-blowing. Some of my friends and I in the investment industry were talking about how funny it is to say, and this manager, Overweiss, was up 115% for the trailing 1-year period. And it's not something that we see or expect to see regularly. But if you look at some of your especially growth-oriented, riskier sort of satellite managers, as you know, Makita and your staff, I think, both prefer that when you're going to hire an active manager, that they do something different than the benchmark and really try to earn their fees for active management, and your managers have done that largely. If we take a look at Overweiss, they're in the first percentile for the 1-year period, essentially doubling the peer group, or more than doubling the peer group return. If we look down at the bottom of the slide, you see RWC Emerging Markets Equity, which is another one of those managers that's sort of considered a satellite, relatively new, hire back at the end of 2019, up 93% for the trailing 1-year period, and also in the top 5% of its peer group. So we've had some quite strong numbers in terms of individual manager performance. I will skip to page 49 just to show you the breakdown of the cash flows for the quarter. So there were net cash outflows from the fund of about $58 million. You can see at the bottom here, but the investment change was up $114 million. So more than made up for those outflows. And so you can see that the market value went from 4.4 to 4.465 during the quarter. I will look just briefly at some of the peer relative data. If we take a look here at page 56, You can see that the annualized standard deviation for the total fund for the 1-year period was 7.9 in the second grouping here. The median for the peer group was 8.4. So your standard deviation looks quite good, even though performance was slightly behind the peer group for the 1-year period, and despite the 30.4% return. You can see that in the third section here, the Sharpe ratio was above median. So risk-adjusted return for the 1-year period was above median for the peer group. And if we take a look at the next page at an even longer time period, and really the page after that at page 58, you can see that the Sharpe ratios remain well above median. So risk-adjusted returns for the 1, 3, and 5-year period are a lot stronger than the peer group. I'm happy to take any questions on performance for the pension fund before we talk briefly about healthcare.
Thanks, Laura. Floor is open. Just jump in, folks.
All right, I know that we just recently reviewed the strategic asset allocation, but anything in your mind stand out right now that we should be thinking about? You've mentioned rising interest rates that we've seen this year. I don't know if there's other areas of concern we should be focused on.
Yeah, I know when we did the strategic asset allocation that, inflation was a topic as well, and rising interest rates, and we did talk about commodities and other areas as well. I think, the fund is very well positioned. I think the performance over the last year bears that out, and also the fact that risk has been lower than the peer group. So, based on the dynamics that we are aware of, we think it's well diversified and well positioned right now. We're always happy to review strategic asset allocation. I know one of the conversations later today is going to be on pension obligation bonds, and that would potentially trigger, another review on asset allocation. We're continually looking at new ideas, but we wouldn't see a need for a wholesale change at this point.
On the attribution effects on page 50 through 52, it shows negative attribution related to overlay. Can you explain that?
So the overlay tries to get you to your allocations, even if you're not physically there. And so in some cases, it might have been, say, positive to let equity run when equity is going up and have an over allocation to equity. But when we bring it back to the target, that would be a negative effect in terms of attribution.
Thanks, Laura.
Thanks, Vince. Floor's still open. Anything else for Laura? Good. You want to move on, Laura?
Sure. Yes, I'll be brief on the healthcare trust. I won't go through the market update here, so I will start on slide 25. Taking a look at the current balance of the healthcare trust at $232 million, with asset allocations very close to policy. And then if we take a look at performance on page 26, you can see also quite strong returns for the quarter, up 3.1, fiscal year to date up almost 19%, and for the 1-year period up over 32. And as we've talked about in the past, other peer health and welfare funds tend to be a lot more conservative. So when we see a down market, your fund, your healthcare trust might not compare well to the peer group, but when we see really, really strong markets, it compares quite favorably. So you can see here that the 1-year return at 32.2 handily outperformed the peer group median of 19% and ranked in the top 15% of health and welfare funds in the 50 to 250 million range. Hopefully the fund will continue to grow, and we'll need to adjust that peer group soon above the $250 million mark. But similar to the pension fund, you see very strong performance relative to benchmarks really across asset classes. And I am happy to take any questions on the healthcare trust as well.
Thanks, Laura. Floor is open. And once, going twice. Back to you, Prabhu.
That'll be all from our end, Mr. Chairman. Happy to take any questions before we move on to item 3.
Thanks. Floor is open. Any questions?
Yeah, one thing, Drew, this is for Laura, I guess. Going back to the retirement plan presentation, page 21, I think there's a typo. Dimensional fund had returns of 63.4, and it says it outperformed on the 1-year basis by 52.5%. I think that's incorrect.
Let me see here. It's quite possible. Looking at the individual manager returns. It should say that the 1-year return for dimensional was 63.4 and the MSCI emerging markets value was 52.5. So it outperformed the benchmark return. So I think that is correct. So we didn't mean that.
I see. Okay.
Yeah.
All right. I interpreted it.
Sorry, I can see how that would be confusing.
Okay. Thank you, Ron.
But yeah, we're pleased to have you point out DFA because DFA EM value is one of those managers that it was painful to hold on to for a little while. So we are glad that they're showing some worth now.
Yep.
Thank you.
Great. Floor's still open. Anything else for Laura? If not, I understand, Pam, that you got to duck out. So if you're on the line, Councilwoman Foley, if you want to jump in and do your report now.
I am. Thank you very much. I have to leave at 10 for another commitment. I'm sorry about that. And I really don't have a long report, but I did want to express my gratitude to police and fire who so heroically worked to save as many lives as possible in the mass shooting last week and the fires that occurred at the same time. I am so grateful that our police department did what they're supposed to do, what we think they're going to do, and what they are trained to do, which is to run into a building into harm's way. I was so proud of them. I was able to meet with some of them yesterday morning and express my gratitude. So to the police officers who are on this call, retired and current, I am so grateful for the service that you give to the city and residents of San Jose. Also, the same goes out for the fire department. You had a couple of major fires, one in particular at the shooter's house, and I understand from reports that it was a very dangerous situation. So thank you as well for running into a burning building and helping take care of our community. I am so grateful, and I know that our community is as well. It was a horrible situation last week to lose 9 individuals from the VTA to a mass shooting is just something unthinkable that we don't think can happen in San Jose, but it has. So we need to make sure that we support the families in any way we can. But I did and support the police and fire who were the first responders, because I'm also concerned about stress on them, their mental health, and issues that may result. And I understand that in the case of PD, 2 of the individuals who ran into the building were police officers sworn in less than 2 weeks before they had that duty. So it's really incredible that the training and the fear and the courage that they have to address. And I'm just so proud of them. I couldn't do it. I could never, ever do that in a million years. So I'm really grateful that the police and fire have such courage and strength to do that. So thank you. That's all I have to say.
Great. Thanks. Any questions for Councilwoman Foley?
No, Mr. Chair, I just want to say thank you, council member, to recognizing the police and firefighters, what they do day in and day out. So thank you very much for your sensitivity and support.
Thanks, Dick. Anything else? If not, we're on to item 3, discussion and action on committee assignments. Linda, can you pull up the list there? Or whoever's manning the screen. Oh, perfect. Thanks. All right. So I've been remiss, and I want to apologize to the board. I haven't been chair before. I'll tell you, committee assignments, you tend to want to do them not every month. You want to do it once or so a year. And so we've been sort of waiting for Franco to come back and take Nick's seat, and then a new active to come on. And we kept thinking, well, they'll come on in March, April, they're going to come on in August. And we probably should have realized that that would be delayed, and I should have realized it'd be delayed. Roberto was kind of poking me, and I should have been really listening. So we're a bit late in making some changes, and we've actually got to make them now before the August meeting. We're almost there, but we can't quite wait that long. So let me take the board through the suggestions that Prabhu and Andrew and Ashfar and Roberto and I worked through, and I've talked to all these members before. So the first thing, go ahead and pull back down again, Linda. Let's look at the board again. So we've got two things happening on the board there. Nick is going to go off in August, and Franco will come on. And Nick, you'll be happy to know that Franco said he'll just step into all your committee assignments right away. Franco's been on the board, so that part's easy. Franco said he'll do whatever we need of him. Franco's a good soldier. And then the vacancy, we've got a new active coming on. We've all met him. He was at a board meeting, I think, a year and a half ago. By all rights, a really good active member to add to our board alongside Andrew on the fire side. So that part's pretty easy. On the investment committee, as you know, Vince had to step down. And so Eshvar and Prabhu and Roberto and I, Andrew, put our heads together. And I think the current plan will be, is that Howard will come in and take that seat. And then Howard and I will work with Prabhu and Brian to sort of wrap up the private equity plan that we started a couple of years ago. And then I will step down off that committee later this year, early next year, and Sunita will come on and take my place. And this is a really good catch because it means we've got solid public experience as well as solid private experience. So I think that transition from Vince to Sunita and from me to Howard will work out very well. In order to get Sunita ready to step into the very large shoes that are required for an investment committee, she's agreed to come on the audit committee, and Howard's agreed to stay on for another meeting or two until Nick is replaced by Franco. Remember, Franco chaired the audit committee, so he's a good catch to have back. So that committee will briefly expand to 4 members. Let's see. On the governance committee, Roberto suggested that we get rid of, right, Roberto, you suggested to get rid of the alternate on that committee. Do you want to say your thinking on that, Roberto?
Yeah, I mean, this will be, thank you, Drew. This will be the only committee that is an alternate. And the only reason we went that route is because we were having trouble getting quorum for those, for that particular committee meetings sometime back. And so that's why we came up with the idea of the alternate. But as you can see, for the most part, your committees just function with 3 members, except for the investment committee, and there are no alternates. So I don't see the need to continue the alternate approach. And as you mentioned, hopefully in the August time, when Nick steps off the board and is replaced by Franco, I mean, Franco and Richard and Howard are always being available for this meeting. So I just don't see the need to continue with the alternate trustee.
Great, thanks, Roberto. So, and then disability and joint personnel stay the same. Do we need a vote on this, or is this just sort of by acclamation? Oh, Roberto, you're on mute, Roberto.
Thank you, Drew. I was just checking to see if you were paying attention, and you are, so you passed that test. I think it's always good to have a motion, but I would suspect that direction we find as well. I don't have the agenda in front of me, but if the agenda reads discussion and action, then there should be an action with the vote. Yes.
Okay, then I'll go ahead and make the motion. I move that we.
I mean, I'm assuming, Andrew, sorry for interrupting you. I'm assuming that all your recommendations have been accepted by all the committee members.
Yeah. Well, I didn't check with the chairs of the committees, but if they have any, well, no, that's not true. Hang on. Everybody has been talked to. I did talk to all the chairs. Just checking. Okay. So I will move that we add Howard to the investment committee, and Sunita to the audit committee, and we get rid of the alternate for the governance committee. Is there a second to my motion?
Second by Santos.
Great. So motion by Lanza, second by Santos. That little ping was Linda reminding me to make it very clear what we're doing, and I think we're good, Linda. Andrew, how do you vote?
Aye.
Sunita?
Aye, thank you.
Word.
Yes.
Ashvar?
Aye.
Julio?
Aye.
Santos?
Yes.
Vince?
Aye.
And this is Lanza. I vote aye. Sorry, they're pinging me. Are we good, Linda and Roberto? We're okay?
Yes, I believe we are. Yes.
We're good, Linda? We got all that?
Yes, thank you.
Oh, thanks, Linda. Yeah. Feel free to ping me, guys. That's very helpful. That's very helpful when you guys do that, Linda. Then we can get it fixed in real time rather than having to loop back. I think it's back. It's over to you now, Roberto.
Thank you, Mr. Chair. So I'll try to be quick. This is my regular oral update for your board. I'm going to start with the vacancy update. Our hopes, and we're working with the city clerk, is that for the retiree seat that is currently occupied by Nick, there was no election because there was only one application, and that application was Franco Vado, who is excited about joining your board again. I can tell by looking at him, and so it's just a matter of the city council appointing him. Our goal is that if he's not appointed on a consent agenda item in June, that it will be done at the first meeting in August, in anticipation of your first board meeting in the month of August. And for the active police seat, as Chair Lanza indicated, Dave Wilson, who had actually attended meetings in the past prior to the pandemic, he was the lonesome applicant. And so again, my understanding is that it's a matter of the city council appointing him to the position. And once again, we hope that that takes place in the first meeting in August. So you should have a full board trustees for your first meeting in August. The city budget is pretty much towards the end of the discussions. There are still some deliberations, but for the most part, all the recommendations have been made. And I think the expectations are that the city budget will be approved in the next couple of meetings, probably if not June 15, certainly by June 22nd. I will keep you posted if anything develops on that. We are in the process of searching for the division manager for the benefit function. You may recall that our former division manager left employment in April. And so we kick off the process in May. We will keep you posted. We certainly hope to bring someone in as quickly as sometime this summer. We did hire for a new benefit analyst position. So we're very excited about that. That's Tammy, and Tammy, congratulations. Tammy is an old employee and staff specialist for the retirement office. The downside is that, she is moving from the healthcare side as a staff specialist to the pension side. So now we have to do a search for her old position. And we are also losing another benefit analyst whose last day is going to be, I believe, this Friday. Barbara, if I'm misspeaking, please correct me. Samantha, who, among many other things, was sort of in charge of working on the deferred retirement options, so commonly known as a draw for divorces. She will be missed. We want to thank her for her hard work and efforts and dedication over her years at the retirement office, and we wish her nothing but the best in her future job and future endeavors. So, Samantha, thank you very much on behalf of the board and also on behalf of the members, and good luck to you. You may recall that we were hoping to bring before you this morning this recommendation for the board medical advisor. We are happy to announce that the reason it's not before you this morning is because we did receive more applications than we had anticipated. And so the work by staff in the review process has been more challenging than anticipated. And so our goal is to bring back for your first meeting in August a recommendation to fill the board medical advisor position. As you know, we made a presentation at your last meeting on the revamping of the website. We continue working on improving and making it more user-friendly, and we're still in line to actually launch the website mid this month, about June 15th. So I will keep you apprised, and when we do launch the website, I will be sending out a communication to all of you, not only to announce it, but also to encourage you to, feel free to go to the website and review it and make comments and let us know how we can continue improving our website. We also indicated at the last meeting that we had the soft launch for the Facebook and Twitter accounts. So that is not something that we are strongly advertising, but we certainly are posting to those accounts every day now. So they are full swing at this point. Further down in this meeting, you see that we are going to be asking you board to consider approving an extension with some dollars for the Cortex governance contract through December 31st, 2021. So we will certainly present that item when we get to it, but the reason I'm letting you know that is you may have seen in the communication section that Tom provided a public announcement indicating that after many years at Cortex, I believe about 25 years, Cortex was closing their doors at the end of 2021. Tom has elected to join a public pension plan in Canada. And so he's actually already working with the public pension plan, but also continue doing work with Cortex, although it is to a limited extent. So we'll have more information during the request of that extension, but I just wanted to remind you in case you have not seen the announcement. And again, I think I want to close it by letting you know that the city, you may know that different counties in California are moving up to different colors in the opening and opening either jobs or businesses around the different counties, and Santa Clara is no different. And so the city has initiated some discussions with employees and everything else. So we will keep you posted on how that develops, but I suspect that we will have some information for the board in not only the city in general, but also as it relates to the Office of Retirement Services. If for some reason we do start some kind of stagger opening before August, I will certainly keep you posted by communication. But again, we will keep you posted on how that develops. But suffice to say that I suspect in the next few months, we're going to somehow see some going back to the office, even if it's not on a full-time basis, and even if it's not everyone there at the same time, and it's scattered throughout the week. We will certainly let you know, and our membership as well. So I will keep you posted as how those news develop.
Hey, Roberto,
yes, sir.
What's your guess as to when the board might meet again in person? You got a guess on that?
So that's a good question. Last I heard, and again, this is unofficially, is that the city was considering having city council meetings, and I don't know if council member Foley is still at the meeting, perhaps having actual physical meetings in August. Again, that's nothing official about that, maybe later. And so I'm only saying that because I suspect that once the city start having the city council meetings physically, they will recommend having different committees and boards throughout the city following suit and having those meetings. I know Council Harvey is at the meeting, and I have reached out to him so that he can apprise us on what kind of information and changes are at the state level, because ideally what will happen is that if we have to go back to physical meetings, I suspect that some trustees may prefer to continue having the meetings in Zoom. And so ideally we can do some sort of a hybrid approach. And we will have to check if we have the ability to do that from the Brown Act standpoint. You may recall that the governor allowed for some flexibility on those to allow for these public meetings to take place remotely like we have been doing through the pandemic. So it's a long way of telling you, I don't have a specific day. I heard possibly August for the city council, but that's not set in stone. And as things will develop, I will certainly keep the board apprised, and certainly we can discuss. If there's a need to be discussed in public, we certainly can bring this issue back at your August meetings. And Harvey, last I heard from council, there had not been any changes to those most recent changes to the law to allow for remote meetings through the pandemic. That hasn't changed yet.
Just, Drew, may I just give an update from the city council?
Yeah, absolutely,
level?
Pam. Jump in anytime you want to. Yeah.
Yeah, we actually thought that when the governor lifts the moratorium on meetings next week, when we remove he removes the tiers, that we would be heading into in-person council meetings as of the following week. But the governor has extended our virtual meetings and allowed us to continue to conduct meetings in the Brown Act. There's a provision that, and virtually, there's a provision for cities with larger than 250,000 population. We're going to have to go back to in-person meetings, but we don't know when. We're hoping August, maybe later. As far as committees are concerned, they are still allowed to be hybrid and virtual with the cities, and that's all we know too. So Roberto, I don't really know anything more than you do, other than we thought we were going to be back in session in person this month, and actually, thankfully, we're not, and it looks like it might be August. But then the committees will be meeting, it appears to be virtually or some sort of hybrid model. Just a little caveat about the council meetings is when we do go in person, there is an option for a council member to participate virtually, but in order to do that, they have to publish where they're going to be virtually 72 hours. So if at your home, you have to announce that you're going to be at your home. And if someone comes to your door to speak at the public comment, you have to let them in to speak. So I don't know which council members are going to want that to occur, but I certainly will be in person when I need to be. So that's all I know. Not really much more than you, Roberto.
Thank you, council member.
That's super helpful. Obviously, we're making sausage, but at least we're talking about the fact that we're making sausage. Marge got more to report, Roberto, or should we get ready to kick off?
Yes, no, that concludes my report, Mr. Chair. So I'm happy to address any of the questions or comments from the board or the public.
Any questions or comments for Roberto? If not, why don't we go ahead and take a 5-minute bio break because we're going to launch into a probably 1 hour, 90-minute session with our actuaries. So everybody come back. What time is it now? Everybody come back at 9:40. 5-minute break. through the deck here. There's Dick and Andrew, and I see Harvey. Before Bill does this, what you're about to see from Bill, Bill, close your ears because I'm about to say really good things about you, is probably one of the best presentations I've ever seen come before this board. And the reason why is because it's a really weighty issue, and Bill, I think, has done a really good job of trying to help us tease out how to deal with this weighty issue. So there's an unbroken thread from the presentation Bill's about to give all the way back to a February offsite at the Hayes Mansion in 2012, almost a decade ago. And Vince gave a presentation at that offsite, and Dick and I were in the audience. And it was partly based on work that the actuaries had given us, saying, you know, you guys have a slightly different risk profile than other pension plans. And we all know this now. Bill's told us this every year, shown us that ratio, that famous slide that he puts up every year. And there's been an unbroken thread since then of, well, how do we deal with that increased level of risk? Vince led an excellent offsite a couple of years ago where we were actually able to quantify that, and Varys and Makita helped us to generate a rationale, maybe right, maybe wrong, for how to pick a portfolio, how to pick a risk, a volatility level that was appropriate for San Jose. As part of that, we also engaged the city in that dialogue. And I think I can say with some confidence that San Jose is a very high function city. I know we don't always think that, but they are. The city council and the mayor picked up on the thread of what we'd been doing and what Vince did at that offsite. And they've been engaged with us in a multi-year conversation about that risk. And it's resulted now in the city, I think, correctly saying, and they having a task force saying, you know, there are lots of levers on the wall. There's one here named pension obligation bonds. Let's see what's behind that. And for the last couple of months, our staff and some of our board members have been members of a task force where the mayor was part of that, and we were part of that, saying, let's take a look at pension obligation bonds. And in my mind, this is kind of a proxy for the city actively saying, let's talk a little bit about risk on our side. We're talking to you, the pension board, about risk on your side, and let's see if we can work together holistically to take a look at risk. And so, Bill, over to you about pension obligation bonds and how to think about them actuarially.
All right, let me share my screen here. All right, can everyone see my screen?
Yep, we got it, Bill.
Nodding heads, so. The city council had their last work session in April, and we haven't really had a chance to talk about pension obligation bonds. And I did talk about some of this to the Retirement Stakeholders Solutions Working Group, if I got that name correct, but wanted to start addressing what pension obligation bonds are to the retirement board, and then look at what the retirement board's role and options are. Because this is something that's largely driven by the city, but then the retirement board will need to address certain aspects if the city decides to go ahead. So I'm going to start by giving just some background and then looking at the underlying dynamics of the POBs, and then get into the board's options. So pension obligation bonds really started back in 1985, and I think you have to say that
Can the rest of you hear Bill?
Nope, we lost him.
Up. Roberto, can you send him a text and let him know he's glitched out? You know, Roberto, it turns out I did have his cell, so I just sent him a text. I was really psyched for this. Oh boy. Yeah, boy. All right. Well, let's go ahead and jump here. Roberto, you want to pick up 4E on the Cortex contract amendment?
Yes, I can do that, Council. So as I mentioned before, Cortex is closing down operations at the end of the current calendar year, 2021. But we are aware that that there is some further work that Cortex has been working on the board. And so I felt it was necessary to extend Cortex contract to December 31st to allow them to work with the boards and complete the work. So to that extent, I'm recommending that the contracts for Cortex are extended to December 31st for up to $25,000. And just to give you an idea, they are going to be have some time to work with both boards on the mock evaluation. This is the work that has been over the last couple of years completed by the JPC, and they agree that there's going to be a mock evaluation review starting in October for the fiscal year ending June 30th, 2021. There's also the board self-evaluation for, for the Police and Fire Board, and some further limited work on governor policies and the joint governor committee meetings. So that will be sort of like the bulk of the work that we expect Cortex to perform with the board. So to that extent, I'm recommending extending the contract to December 31st for an additional $25,000.
Thanks, Roberto. Any discussion on this? I'll entertain a motion on this.
Motion by
Motion to approve, Sunzeri.
Motion to approve by Sunzeri. Nick, will you second that?
I will.
That's great. All right, we've got a motion by Sunzeri, second by Vince, and we'll go around the room. Andrew?
Aye.
Sunita?
Aye.
Howard?
Yes.
Eshvar?
Aye.
Nick?
For the record, it's motion by Vince, second by Muyo, and yes.
Well, thank you, Nick. Motion by Vince, second by Muyo. How do you vote, Muyo?
Aye.
Santos.
Yes.
Lanzeri.
Aye.
I'm Chair Lanza. I vote aye as well. I have this sneaking suspicion that Bill is just talking. Doesn't know we're not listening. Poor Bill.
No, he did mention he has some trouble with his Wi-Fi, obviously, and I don't know if this is just some way of the higher up letting us know that this is not a discussion we should be having. But
yeah,
that aside,
don't tempt the fates. Yeah.
That's right. That aside, he is trying to reconnect. So.
Oh, good. Okay, that's great. Hey, Root, do you want to move on then to 4 and F, the calendar issue?
Yes. So thank you, Chair Lanza. I brought this issue forward to both the chair and the vice chair of your board last time at the agenda review. And as you may know, the annual performance review of the CEO and CIO takes place right when you come back from the month of July. So usually your board meets in the closed session, first meeting in August, and then the federated does, and then there's some discussions, and then both chairs compare notes. Also, the chairs of the investment committees, and so it's about a 3 months process. The situation with that is that a 3 months process goes beyond the deadline that the city generally use to process the annual increase for the employees, meaning that the CEO and CIO usually have to wait until the month of February of the following year for the increase, even if your board made the decisions by the October meetings. So what I'm recommending is that it just so happened that this year, September actually has 5 Thursdays. And I just felt that moving up your board meeting from September 2nd to the 9th, and I'm going to be asking Fed to move theirs from the 16th to the 23rd, will give both chairs and IC chairs 1 more week to compare notes, draft the evaluations based on the respective board's comments, and able to sit down with both the CEO and CIO to discuss the performance evaluations in anticipation for your September meetings, so that if you're able to then, if that process is completed, then you're able to make a determination and take action on first whether you will be recommending an increase for the coming year for the CEO and CIO, and if so, how much would that increase will be. And using those deadlines, then we'll be in line with the due date process for the city. So that's really the reason why I'm politely requesting that your board consider moving your day from September 2nd to September 9th. I'm happy to answer any questions.
Anybody have any questions? I was thinking we just go around to see if everybody can pull up their calendars, just to see if everybody can make it. Are there any questions before I go around, Robin? Let me pull up my calendar here. I'll go first. I already checked. Yeah, that works fine for me, Roberto. How about you, Andrew?
Yeah, this works for me too.
Great. Let's see who's next. Sunita, does that work for you?
Yeah, no issues.
Howard, does that work for you?
Yes, I'm okay.
Great. Ashfar, can you do that?
Yes, that's good. Thank you.
Muyo, can you? Oh, Muyo. Well, you'll be off on the beach somewhere, so screw you.
Hey, for what it's worth, if you need me to step in, I'm available.
All right, Santos, can you move it to the 9th of September?
Yes.
Great. Vince, can you do it?
I can. I just want to point out that that means we've got to read the board packet over the Labor Day holiday. But that's okay. I'll do it.
All right, I think we're good on that. I got to ping. Bill, are you back?
Yes, Drew, Bill is back, and he apologizes, and he thinks his Portland Trailblazers fault that they cut the Wi-Fi because they're behind in the NBA playoff, but don't tell him that. So he's looking forward to making the presentation.
I knew Roberto would slip that in.
Roberto was warning us, watch out for the flash of lightning and the peal of thunder, but apparently it didn't happen. So, Bill, you went out right as you opened talking about Oakland.
Yes. Let me try sharing my screen again and see if we can stay.
Well, Bill does that, Drew. I know you asked each trustee if they were available, but did the board actually take action on the matter so that you don't have to go back to that item?
Well, that's a good point. Let me go ahead and thank you, Roberto. Let me make the motion that we change the date from the 2nd to the 9th of September. Is there a second?
I'll second, Sanzeri.
A motion by Lanza, second by Sanzeri. Going around quickly. Andrew?
Aye.
Anita?
Aye.
Howard?
Yes.
Schvar?
Aye.
Julio?
Aye.
Santos?
Yes.
Sanzeri?
Aye.
Chair Lanza, I vote aye as well. Thanks, guys. Okay, back to you. Sorry, Bill.
I apologize. So I was saying that pension obligation bonds started with the city of Oakland in 1985. And they made a very brilliant move, I think, in realizing they could issue a tax-exempt bond and invested in higher yielding taxable securities. And so essentially create an arbitrage between the taxable and tax exempt yields. It was basically a guaranteed significant advantage, if not guaranteed return. The Tax Reform Act of '86 quickly took care of this. Congress realized that they were being taken advantage of with the tax laws, and so they closed this loophole and eliminated the tax exemption for pension obligation bonds. There is, still a possibility to get an arbitrage if the city is able to issue a bond for another purpose that they were going to fund out of their regular cash that would be tax exempt, and then use the regular assets of the city to make an increased contribution to the pension plan. The municipal advisor for the city referred to that as a tax exempt exchange if you were looking at the city council presentation in April. But other than that, you can't take advantage of that arbitrage opportunity. Since that time, the argument for pension obligation bonds has often been based on an argument of what we call actuarial arbitrage, of looking at the difference between the borrowing rate and the assumed rate of return. Now, the word arbitrage implies that there's a guaranteed gain, but there is no guarantee here because the actuarial rate is just an assumption. And it is what you get in the market and not a guarantee. So it's not really an arbitrage. Using a study done by the Center for Retirement Research, there were 105 billion in POBs issued in the period from 1985 to 2013. I just saw a presentation by Standard & Poor's that showed a significant increase in POB issuances with about 16 billion in 2020. About 14 billion of that was issued in California. And they said 2021 was off to an even hotter start and probably would have larger issuances than 2020. If you look at these, the success or failure of them has largely depended on the timing of the issuance. If they're issued just before a market upswing, they're very successful. And if they're issued just before a market downswing, they are not. Here are some charts from the Center for Retirement Research on the issuance of POBs. The top chart shows them by year, and you can see 2003 was a banner year, but most years have been much smaller than that. And then the bottom chart shows them by state, and you can see that California was a leader in issuances particularly prior to 2009. There have been much fewer since 2009, but as I said, we're seeing a comeback in the last couple of years. Now, it's important to understand that they don't change the total liability for the plan sponsor. From the pension plan's perspective, the POBs do reduce the UAL. But if you look from in our case, from the city's perspective, the city has its own debt from bond issuances, and then it is responsible for paying the pension UAL for Tier 1 and the OPEB UAL. When you do a POB, all you are doing from the city's perspective is you reduce the pension UAL, but you replace it with the debt for the POB, and you still have the city debt. So the total amount of debt from the city remains the same. The rating agencies and others often refer to this as exchanging a soft liability for a hard liability. And what they mean by that is the UAL from the pension plan fluctuates with experience. And so that is sometimes referred to as a soft liability. But the pension obligation bond, that is like a debt or a loan. And so it is a fixed liability that does not change. Now, from the city's perspective, again, it's very similar to adding leverage to the plan in the portfolio. So in the current plan, we have the pension plan's assets. If you add a POB, we still have those assets, and then we have the POB assets on top, and then the city has the POB debt. And so the net, if you take into account the city's debt, remains the same. Now, some plans, actually quite a few plans now, are starting to add leverage to their portfolio, which is doing the same thing, only within the portfolio, they are borrowing money and investing that in the portfolio. In both cases, the idea is the same. You borrow assets at a low interest rate, you invest the proceeds in the pension investments, and with the intention of getting a higher return than your borrowing rate. And as long as you get the higher return than the borrowing rate, you come out ahead. The differences are who issues the debt, who makes the decision, and how that plays out. So with a POB, it's not the retirement board's decision, it's the city's decision to issue the debt and put the money in the plan. With the POB, in a bankruptcy, the retirement plan comes out ahead because you get to keep the assets that you got from the POB, and the bondholders have to go after the city. And in the case of a bankruptcy, the bondholders would get shorted. Whereas if you're doing it within the trust, the bondholders would be able to come back to the trust for their security. So there are some differences, but in an ongoing situation, if you step back and look at it, particularly for a single employer plan, you can see the plan sponsor and the plan are linked at the hip. And so the overall structure and effect from that broader perspective, it is the same. Now, what they have done is they do change the contribution pattern. And so I didn't try and mimic our amortizations in this illustration, but just looked at interest-only payments. So we have interest only on the pension UAL, which we're calculating at 6.625%. And after the POB, that pension UAL drops. And so the interest payment on the pension UAL drops. And then you have the interest payment on the POB, but that's at a lower interest rate. So here I've done it at 3%. And so if your policy was just an interest only, which is not what I'm recommending, but just showing for illustration, the contributions, the total contributions, both to the trust and to pay off the POB would be less than what the contributions were just to the pension trust. Those POB payments are fixed. They can structure them so that they do have the option to refinance at periodic times, but other than that, there's no change in those payments throughout the term of the POB. The pension UAL, the payments, we know those payments change all the time. We change them every year. And the board has the authority to change how those payments work. And we have done that. We can change the payment schedule at any time. This lower interest payment, though, can create an incentive to issue a POB. And it also can create the appearance of that actuarial arbitrage, or the idea that you're refinancing a debt, which is not exactly what's going on here. So when we look at the POBs, I borrowed some of the findings from the city's presentation to the April City Council meeting, just to make sure that we're all understanding their perspective and figuring out what makes sense from our perspective. They note that retirement costs are an increasing portion of the general fund budget. And they have gone up from 6.5% to over 20% of the general fund budget. And they note correctly that only Chicago has higher fixed costs as a percentage of government expenditures. We're looking at debt service plus contributions to the pension and contributions to the OPEB. And that level of funding constrains their ability to pay for other city priorities. And they were basing this on a $3.7 billion UAL as of June 30th, 2020. So that's what they were looking at. Here's the projected city contributions that they're looking at. And they noted, so I've got the federated pension and OPEB in green, and the police and fire in the blue and the teal for the OPEB piece, and getting the total. So they're looking at this total contribution increasing over time, and stating that that is a significant issue for them. So the benefits they're looking for, they stated they wanted to reduce contributions for pension and OPEB. You know, I would say that there was a lot of talk about recycling some of those savings. So not necessarily completely reducing them, but having some control over that. and preventing contributions from rising through 2029 that would erode funding for other city services and programs. So yeah, they were looking at using the savings either to accelerate the amortization of the UAL or ease current budget pressures. And so that would be a decision that they would be making. So I wanted to clarify a few things on this. First, San Jose and Chicago are in very, very different circumstances. So that's not really an apt comparison because in San Jose, we've chosen to have the contributions high in order to pay down our UAL. Chicago's payments are just to keep going. They are not actually paying down the UAL, and their plans are in much worse funded position than San Jose's. I think Drew used an analogy years ago that kind of hits the philosophy we have followed in setting the contributions where they are, which was that it's sort of like chemotherapy. We wanted the contributions to be high enough to cure the disease, but not so high that we kill the patient. And I think that's an excellent analogy. And the challenge is figuring out where that right level is. And we've talked about that almost every year, I think, trying to figure out where is that right level? How high can we make the contributions to pay off the UAL quickly while still not harming the city? So if there's an objective to get a different pattern of contributions, if the contributions we've set are impinging on priorities that should take precedence, we have the flexibility to adjust that somewhat. We have our fiduciary responsibilities to make sure that the pension is funded, but there's a range within that. And particularly on police and fire, we've been fairly aggressive at trying to get the contributions in and get back to 100% funded. If we take a more lenient approach, there are some risks that we would need to assess, but there is some give and take. And so if there is a different pattern needed, particularly with a single employer plan, it should be a conversation between the city and the retirement boards with their different perspectives. And our role is to make sure we get enough to fund the plan. The primary dynamic for the pension obligation bond should be the economic impact over the longer time period, where you are borrowing at that low interest rate and investing so the return hopefully exceeds the borrowing rate, and not directly looking at the contribution pattern and just trying to reduce current contributions. I think that's where a lot of other systems have gotten in trouble, is if the primary reason for issuing the POB is to reduce the contribution, they can end up structuring it so they're essentially kicking the can down the road, and eventually the chickens come home to roost. So the other thing I wanted to add to the city's analysis is they took the latest numbers available that we had put out in our projections. And so they are absolutely correct, but those were based on June 30th, 2020 numbers. And we know that the returns this year have been much better than expected. So the returns, I understand, are all slightly above 20% for the different funds for the year. And so just assuming we get a 20% return for the full fiscal year and all of our other assumptions are met, So these aren't final numbers, but should get you in the ballpark. The aggregate funding for the pension, the UAL combining federated and police and fire was 3.7 billion. We would project it to drop to 2.9 billion, and the assets to have increased from just below 6 billion to just above 7 billion. It's a pretty significant change here in the liability. The aggregate funded status increasing from 61% to 71%. OPEB is smaller, but has a similar dynamic, increasing the funded ratio from 41% to about 49% for the combined OPEB plans. Now, that really changes these projections. So the bars here assume we get a 20% return for the current year, and the line shows the prior projections that the city was using in their April presentation. We've talked a lot about how mature the plans are and how sensitive they are to investment returns. We usually talk about that in the negative situation. It also works in the positive situation. And
Can I ask a quick question here?
Sure.
So the previous chart, does it assume that the 3-year smoothing that you do?
No, the prior chart, this is showing it based on the market value of assets. So that's no smoothing.
Not the actuarial, okay.
This chart does take into account the actuarial value to develop the contributions. And so that's why you see for 2023, which is the year that will be the contribution year that will be based on the 2021 valuation, there's a reduction of about 16 million. But after you get out about 5 years, you're looking at a change of about $95 million reduction in contributions.
And the previous chart, do you know what the number would be just for the PNF?
I have it underneath, but I don't have it at my fingertips.
Okay, thank you.
Actually, while we're on this chart, I have a question.
Sure.
I guess, were you surprised to see that the green bars, those are the federated numbers, don't go down as much as the PNF, given PNF is a better funded, in a better funded position?
Well, that's exactly why they don't go down as much, because take the extreme. If you had 0 assets, a 20% return doesn't help you much. But if you have a lot of assets, a 20% return helps you a lot more.
So basically you're assuming the same returns as the plan's existing returns.
We're saying that federated got a 20% return and police and fire got a 20% return.
Mm-hmm.
But if federated's only 50% funded and police and fire is 70% funded, police and fire is going to get a bigger bang out of that additional return than federated.
Okay, I guess I have to think about it, but I understand what you're saying. I'm good for now, yeah.
Any more questions? Keep going, Bill.
Okay, so I think this is an exciting change. Of course, a lot can happen between now and the end of the fiscal year, so we can't book this yet, and a lot of things can happen in the future. But if we hold this, at least we're no longer looking at increasing contributions through 2029, but holding steady and actually decreasing somewhat to 2029, which I think was one of the city's concerns about the contribution levels. So the outlook is much better now. There's absolutely no guarantees. all of these projections assume, all of our assumptions are met in the future. So the 6.625% returns along with everything else.
And Bill, if I may ask one more question. So you're assuming that the bond covers all of the unfunded liability?
No, I haven't brought in the bond at all. This is before doing any bond. This is just the investment returns for the current year.
Oh, I see. Okay.
Bill, if I can jump in here for a minute, I want to talk a little bit about the leverage and how you're framing that. You're basically framing it as the plan is becoming leveraged. And the way I'm interpreting it is it's on both sides, both the city side and the plan side. So, okay, correct my understanding.
So it's, if you're just looking at the plan, you just have the assets and you're investing. And so you have more assets. And so when we look at things like that asset to payroll ratio, yes, that's going up. But because it's the city that holds the debt, it's the city and the city's contributions that are leveraged.
Okay, and I think that's a very important distinction to make. And I'm not sure that comes through clearly, and maybe it does further in your presentation, but the immediate response that I get is this plan is taking on leverage, and you did a comparison earlier where you looked at plans that have POBs and plans that take on leverage, and it reflected a very similar view. And I just want to be really clear that this distinctly different on the asset side for plans that may truly take on leverage versus plans that receive POB money.
Right. So if you are looking at just the plan, it is distinctly different. And that's what I was trying to go through on that slide. But if you look at it from the plan sponsor perspective, they end up being the same economically. The difference is who made the decision. So it was not a decision of the fiduciaries to do that. And it's only the leveraging effect comes through in the city's contribution rate.
So Bill, can you go back to slide 7 real quick?
Yeah, and when I say the city's contribution rate, this is another thing to make sure is clear. So I'm glad you're asking this and getting it clarified. So
on slide 7, Bill.
This is the contribution piece.
So the way I'm interpreting this slide is it's somewhat generic. I don't see it as being clear that the city maybe is adding leverage to their balance sheet. I know that you referred to it going from a soft debt to a hard debt or soft liability to a hard liability. But this here to me looks like the plan is borrowing assets and has a liability. And if the public and the uneducated individual were to look at this, they might think that that's analogous to us levering up our plan and borrowing assets. And the dynamics, the mechanics, the financials are so much different. And I feel like we need to be really careful about how this is being framed as we're in a public environment.
Yeah, so let me point you to the last bullet here, because I'm trying to point out that the difference is whether the city or the plan owes the debt. So in the add leverage case, that would be the plan owing the debt. And in this case, it's in the POB case, it's the city owing the debt. And so that has, and so you still have the same dynamic, but the green items here are the assets in the plan. The debt in the POB case is held on the city's balance sheet. And in this case, if you made the decision to add the leverage, that debt would be a part of your portfolio, right? So those.
I don't know if I would say it's the same dynamic, because maybe for the city and their balance sheet, but for the plan itself, the mechanics of adding leverage and the risk that that brings with it of potential drawdowns and margin calls and liquidation requests are things that don't happen with plan assets when you receive POB funds, but would happen if we were to margin the plan.
Right. So there are some differences also in the way the debts get structured, which gets to your margin calls and those sorts of things. But this is from the city perspective, their contribution rates are going to fluctuate in a similar manner. If it's all within the pension plan, what we end up doing is just reporting more volatile investment returns that track through to the city's contribution rate, right?
You're assuming that there's more volatile investment returns. That may not necessarily be true.
Well, then the same returns without the leverage?
Let's just assume it was invested exactly as the entire plan is invested. The plan would be no more volatile with another $1 billion than it is today.
No. I'm talking about if the plan added leverage, then the plan's investment returns would be more volatile.
Correct.
If the city does with the POB, the plan's investment returns aren't more volatile, but that's because the debt payment is outside of the plan. So the city's returns, effective returns that flow through to the contribution rate, and the contribution, including their payment on the debt, is more volatile.
All right.
So
I think you've done an excellent job here. For me, this one particular slide doesn't make the distinction. And I just want to make sure we're on the record and clear about how this comes into play for both the city and the liability side and the plan asset side.
Yeah, so on the contribution piece, I was trying to note here after the POB, before the POB, the city just has the pension UAL contribution. After the POB, the city has both a pension UAL contribution and a POB contribution. So when I start comparing city contributions before and after the POB, I'm not talking about just the contribution to the pension plan, but also adding on the contribution they have to make to pay their POB off. So that's a distinction to make sure that we follow as we go through this. I'm looking from the city's perspective at their total contribution to pension, including the POB. And that is, we've looked at the pension contribution, or the city has pointed out the pension contribution as a percentage of the general fund budget. Then if you add a POB, that POB would be a part of the general fund budget as well. So from their perspective, looking at the budgeting, you need to add both of those together to get sort of what they would view their total pension contribution to be.
Got it. Thanks, Bill.
Actually, can I just?
Yeah.
I agree with Vince on slide 7. I think the problem with slide 7 is the first bullet point says POBs are the same as adding leverage to the plan. Whereas what you just said is it's not, because the plan could borrow, which is, I don't believe that's a decision on the table right now. It's about what the impact of a POB is on the plan. And the only impact is it increases our asset base. I think it's the first bullet point that I find a little sort of not accurate, so to speak.
Yeah, I guess the first bullet is from the city's perspective and not from the plan perspective.
What doesn't matter whose perspective it is. You're not adding leverage to the plan from what I understand. Actually, I didn't appreciate it, and I really appreciate how you're explaining it. I thought it was adding leverage to the plan. I attended the April meeting, but it isn't. As far as the plan is concerned, it's agnostic whether you receive the X billion dollars of POB money today or you receive a stream of cash flows that are contributions from the city. It's just the investment horizon and the way that when that money is deployed is different. That's how I think about it.
Yes, yes. That's exactly right. And your role will be based on just receiving the money and then deciding how to invest it. And it's the city's issue to pay the POB. The only place that intersects with what we've done is in looking at what kind of burden we're placing on the city in terms of our contribution rate. Now there's also that POB piece.
Well, and not to make too fine a point on it, and we'll talk about this when you're done, Bill, but I actually think that the impact of a POB will be to de-lever the pension portion of their portfolio, but to lever their overall portfolio, where leverage is defined solely as using debt to generate an increased return on assets. So I'll save that for later. But yeah, you're nodding your head, so you know what I'm talking about. Great, keep going. Thanks, Bill. It's really good.
No, that's exactly what's happening from the city's perspective. Is they are borrowing money to put in the pension portfolio, and they get, because they're responsible for paying the UAL, they get the benefits of that leveraging. They also pay the costs. Let's see, where was I? Okay. So now we get to the retirement board's role and their options. So our role is to make sure the benefits are secure. And in setting the funding policy, we've also tried to create some contribution stability and predictability. We do that with the asset smoothing. We do that with the amortization periods. And balancing that with generational equity, which we also do with the amortization periods. Those work in opposite directions. If you want stable contributions, you use really long amortization periods. If you want the best generational equity, you use shorter amortization periods to a certain extent. And certainly, if you want to maximize benefit security, you use a short amortization period. But those short periods create extreme volatility for the sponsor. And so we struggle with that, or not struggle, we wrestle with that balance to try and find the right balance between those things. The city has to pay whatever contribution we adopt. So we're lucky in that regard. There are a lot of places around the country where that's not true, and some of those have really gotten in trouble with pension obligation bonds. I think the classic case that gets called out is New Jersey, because they did a very large pension obligation bond just before the dot-com bust, and that led to a period of approximately 20 years where they did not make the actuarially determined contribution, while the bondholders did get their full payment. So it was the pension plan that suffered because of that. Our current funding policy is built around the idea that the city is making regular annual contributions. You know, they can make a lump sum at the beginning of the year, but it's really built around regular annual contributions that get put into their annual budget. We haven't really addressed what happens when we get a large lump sum that's financed by a bond. And so we need to decide how we would treat such a deposit and how we are coordinating that with the city's expectations. And so this is kind of the nut of what I wanted to get to today. The board would also have questions about how to invest those assets. That's not my space, so it's not in this presentation, but that's also something that would need to get coordinated here. The traditional methods, the first level method is you just do a normal amortization credit. So when we do our valuation, we have all those amortization bases that we've shown you and gone through. Those all add up to the total current UAL. If you suddenly reduce the UAL by $1 billion, we need that total to add up to $1 billion less. And the way we would normally do that is just create, in your case, a 15-year amortization of that $1 billion as a credit against all those other amortizations. And that would play out. And we wouldn't pay attention to what the terms of the bond were at all. Then the next step that a lot of systems have adopted is to match the terms of the bond. So at least then you're not getting a mismatch over the time period, and you set those terms. CalPERS has done another method, which I think makes a certain amount of sense when you've got 3,000 employers in one system and they're not tracking what different employers are doing, is that the employer can actually select which piece of the UAL they're paying off. And so they can do their piece. So we'll talk about that. And then we have a proposed method that would not change the total city contribution immediately. It would let we would effectively reduce the city's contribution in the first year by the amount they have to pay on the bond, so that when you add those two together, you get no change. And then we'd adjust that going forward, depending on what actual investment returns were compared to the bond rate. So I'm going to go in more detail on those. So the normal amortization credit is what would happen if the board makes no decision, because that is what our policy is. Right now, that's geared for if the city contributions are slightly more than we expected, we would then amortize that slight additional amount over 15 years. The issue again is how that stacks up compared to how the POB is structured. And it also, the other thing to note is that payment changes every time we change the discount rate, the payment increase rate, or the amortization period. And that may not be desirable from the city's perspective. If they are structuring a bond a certain way, they may want to know that certain parameters are fixed so that they're matching up their credits in the pension plan with their payments on the POB. But in all ways, the POB proceeds are just treated as plan assets, and we look at the gains and losses. If we take a slightly more refined look, we can look at the actual terms of the POB structure and mimic those in the pension plan so that the pattern of credits matches the pattern of their payments outside of the plan. That takes away the city's option to do some of the most risky approaches. I don't think San Jose is considering this at all, but you could have a situation where we are amortizing over 15 years and we're giving them credits over 15 years, but they did a POB over 30 years. And so they're gonna get significant reductions in contributions for the first 15 years and then have those POB payments remaining for the last 15 years. If you do this, the only thing that I've seen allowed to change on that structure is the discount rate. As you change the discount rate in the future, you may change the payments, but because you were trying to match the basic structure of the POB, you generally try and keep that fixed for the duration. But everything else proceeds as normal. So I have this as an interactive model so we can flip to it and try some different scenarios, but I wanted to just show you sort of what you're looking at and how this may work. And I just modeled a $1 billion POB in our current structure, 6 5/8 discount rate, a payment increased rate of 2 1/4, and an amortization period of 15. And then for the POB, I assumed they would get a 3% interest rate, but structure the payments the same way that we have our amortization payments structured. And so in the traditional approach, the green area shows what we would have seen in the pension plan as payments to pay off $1 billion of the UAL. And the blue bars show what the POB payments are. And then on the bottom, we have the net difference. And so just in this structure, if we got our 6 5/8 return over the whole 15 years, the POB would generate gains. And this would be very much like just refinancing at a lower interest rate, right? The thing that's different from refinancing at a lower interest rate is these 6.625% returns are not guaranteed, they're not fixed. But in our expectation, the city would have lower contribution payments for 15 years. Now, if we actually earn 0% for 5 years, and then 6.625 in this structure, the green still takes the pension payments, including the losses on this 0%. The gold bars are the additional pension payment that would be due to the POB proceeds being there for the 0% return. And so if you look at the blue bars are still the payments on the POB, and then the gold is the additional payments due to the losses for the 0% returns on just the POB proceeds. You can see the city still comes out ahead for about the first 6 years. And then they have to start paying more. And after 15 years, it's a fair amount more. So does that make sense to everyone? What's going on there? Now, of course, what we all want to happen is we put the POB in and then get good returns. And so in this case, the gold bars are the additional returns on those POB proceeds, further reducing the contribution. And so then the city's net effect is significantly positive during the whole period.
So, Bill, can I ask a clarifying question on your 0% example?
Yeah.
So it's probably a basic question. So this just illustrates that the obligation of the city is still to, is sort of, I mean, there's ignoring time value of money is still a constant in the sense they are not, their obligation to fund the plan continues, notwithstanding the fact that they have contributed $1 billion through the PO pension obligation bonds into the plan. Is that the way to think about it?
That's one point. The other point is, you know, if the actual returns are less than the 3%, so there are a couple things here. If the actual returns are less than the 3%, in the long run, they're actually going to pay more because they borrowed money at 3% and got a 0% return for a while. And then they got the 6.625. We could show what I can show one in the interactive where they got 3% returns every year, and it should net out to the same total present value, but they would have it would be kicking those contributions to later years. So that's the other dynamic that happens here, is because they're getting credits for putting in the $1 billion up front, assuming that we're going to get a 6 5/8% return on that $1 billion, they get those credits up front, and then if they don't get it, they have to pay for it much later. And so this has been one of the big incentives for distressed plan sponsors in doing a POB, because in the short term, it's difficult not to have a positive outcome if this is how the retirement system handles the POB. And so it serves as an enticement to do a POB, but particularly for distressed employers. And so that's where we've really seen some of the issues. And that's, the city talks about how the GFOA, the Government Finance Officers Association, has some pretty strong statements against POBs. And I think my take on those statements is that people have been induced by this short-term gain more than understanding sort of the long-term risks and how you manage that. And that is the real risk for the POB. And kind of one of the points I'm trying to get to is, from the retirement system perspective, do we want to offer that inducement to do a POB, or do we want to make the contribution impact more neutral at the beginning and wait for the POB to pay off to reduce the contributions? So that's the dynamic to consider. I'm not suggesting that San Jose is doing this for this particular purpose. In fact, they spend a significant amount of time talking about recycling the gains, I think is the way they phrased it, or something like that, where they would still continue to make the same contribution to the pension plan and only recognize as future deferred gains. So, but we'll get to that more. But one of the dynamics here to note is how even if there are losses, it kind of kicks the payment of those losses down the road.
Bill, I got a question follow up on this slide here. on that back to the last slide, where the first 5 years you're at 0% return. And that definitely creates I guess an additional, if you want to say, additional unfunded liability, and it snowballs things down the road for more losses. If this was a scenario that played out and it created the additional unfunded liability, is that would be on the city's books, right? Not the pensions books?
No, the unfunded liability would be on the pensions books, which also translates to the city's books.
Okay, so then so in this situation, then this would have, if pension obligation bonds went, not in our favor, this would impact normal cost then for both the plan and the members.
No, it does not impact the normal cost. It only impacts the UAL.
Oh, I apologize. I meant UAL. And with tier 2, the UAL is split 50-50.
Right. So a 0% return is going to affect tier 2 member contributions. Independent. I believe the city is trying to target the POB contributions to the tier 1 UAL.
Okay. Okay.
And when I say it creates additional UAL, it creates additional UAL compared to getting the 6.625% return. But if you are starting $1 billion higher in assets, it's not necessarily a greater UAL than you would have had without the POB.
Mm-hmm.
It's the issue for the city is they still have to pay off the POB, and then they have these additional costs that they weren't expecting.
Yeah. Okay. Thank you.
Bill, I have a couple questions.
Mm-hmm.
One, going back to slide 18.
This one?
I'm a little confused here where it says these are board options for amortization, but under the traditional method, you're listing the city has the ability to select amortization on the POB side. So it seems like this could be taken out of our hands on that component.
You would have to adopt that policy to allow the city to do that.
Okay. They couldn't unilaterally make that decision.
No.
Okay. And then going back to your slides, actually not going forward to slide 23. So here we have, these higher returns, and clearly there's a benefit to the city that they, in fact, did the POB, put the funds in, got higher returns, and now their future contributions go down. I worry, and maybe you can give us some historical perspective on other examples of influence and risk-taking. So for our plan, we've had lots of dialogue with the city over the last 5 years about the level of risk that we've been taking at many joint meetings, city council meetings, on why this plan is not taking more risk. And I can envision that this might potentially bring up those questions again now that a POB is brought in additional funding to the plan. Because clearly there could be significant benefits to the city if we take more risk and get higher returns with those assets. Do you have experience on other plans that have done this and how that dynamic may have played out?
Yeah, so different plans handle it differently. I don't have experience with other systems that have gone as detailed as you have in trying to coordinate the level of risk with the plan sponsor. The larger state systems tend to say, this is what we're doing with the assets. It's up to you to figure out the risk at the sponsor level. You know, and like using CalPERS as an example, they've got 3,000 different employers who all have different risk tolerances. They can't like coordinate that with each one. So they have set one policy, and then it's up to the individual sponsors to look at. I do think in the framework that that you've been working with the city and with Veris and looking at the risk levels, and with Makita, there are some questions here that could be impacted depending on the size of the POB and what the terms of the POB are. It's hard to get too detailed on it until we have at least some ballpark numbers to work around with. We can mock some stuff up with a $1 billion POB, but it's, you know, and it would be different whether it goes into the police and fire or it goes into federated. So there are just a lot of variables there, but I think that's part of the discussion down the road.
Okay, and my last question, and I might be jumping ahead on your presentation, is thinking about the size of the POB specifically to police and fire. Has there been communication between the city and Chiron about how large of a bond to issue to get the plant up to a particular level of funding? And if there hasn't, is there a recommendation you have of what funding level we should get to when we issue a POB, or when the city issues the POB?
No, we have not had a discussion like that. I think their municipal advisor raised the relevant issues in the city council presentation. They talked about getting to 100%, but my recollection was they weren't recommending that. And I would agree that you don't go all the way to 100%. And part of that is the benefits of ending up 150% funded are not as great as the concerns if investment returns didn't turn out and you have the sponsor in this position where they owe on the bond plus having the pension payment. So we haven't done any analysis. There'd have to be a fair amount of back and forth to figure out what risk levels the city wanted to tolerate and what they were trying to target and what the board's view of it was. But I would say, you know, it's generally lower than 100%.
Okay, thanks, Bill.
Bill,
yeah.
Can I ask a question? And this may, you know, may not be right to the point. I realize the, well, to some extent, implications of investing the funds of the POB and not having good returns, so having returns below the interest rate that the city will be paying the bondholders. But the question I have for you is there anything the board should be thinking about in how they address the POB issuance, the investment, and the amortization to limit the impact on the tier 2 members? I mean, is that something that they should think about when they think about this? Because obviously the city is trying to pay the unfunded liability created by tier 1, and also tier 2 members share the unfunded liability with the plan sponsor 50-50. Is that something that we should talk about, or is that really is nothing to consider in this discussion?
Well, if the city is depositing the POB proceeds specifically for the tier 1 UAL, then I don't think it has any effect on the tier 2 people, because the assets will go into the tier 1 city account. And that's separate from the tier 2. So tier 2 would just operate as it has been. If they're not.
Can I stop you before you go to the next explanation? Let me just kind of like the Social Security. Let me just make a statement there about what you just said. When you said about the investment to the tier 1, you mean from an actual standpoint? Because as you know, our investments are commingled. We don't have a tier 1 and tier 2 bucket in the office. We do,
right.
We do, actually speaking, but when Prabhu's staff made investments, we're not telling the money managers these are for tier 1, these are for tier 2.
Right. So to the extent you change the investment policy because you received POB proceeds,
okay,
that could affect tier 2, and it could raise the issue again of whether you have separate tier 1 and tier 2 investment strategies.
Understood.
But assuming there's no change in the investment strategy, then it does not impact tier 2, because when we receive asset information, the earnings are allocated between tier 1 and tier 2, and we have specific assets accounted for tier 1 and tier 2, and this would just add to the accounting bucket for tier 1. So unless it changes the actual investments that get allocated to tier 2, there is no impact on tier 2.
Okay, understood. Thank you. And I stopped you were saying something that this was the other part of it that you were explaining.
Well, I was just going to say, if the city doesn't designate it as tier 1 and it comes in and gets allocated across tier 1 and tier 2, then that would be a different matter.
Yes.
But my understanding is that they are specifically targeting tier 1.
Might as well. Okay, thank you very much.
Okay, I wanted to quickly run through the CalPERS method. And the reason I'm doing this is the method that the municipal advisor presented to the city council. And so the board would have to adopt this method to make it work, because otherwise our current funding policy would not do this. So the CalPERS method allows the city essentially to adjust the contribution pattern by picking specific UAL amortization bases to pay off with the POB. And so the city can control the degree of match or mismatch between the bond structure and the amortization payments. And so I do have a couple concerns about this, especially given that we're a single employer system and not a multiple employer system like CalPERS. And one of them is it really makes the POB appear like it's refinancing, because you take one specific amortization base that's at 6.625% and you pay it off with something at 3%. It makes it look like you're just refinancing that base, which is not the way I look at economically what's going on. The other issue is the board is designated with setting the funding policy. And so this ends up being an exercise in how the city can change the board selected funding policy. And so at a minimum, I would think the board would want a say in a discussion about how you're paying off amortization bases, rather than just letting that be selected by the plan sponsor, because it fundamentally changes the payment structure that has been set up by the board. So just to remind people, we use this chart to show the payments on each of the amortization bases. And so each little purple square is an assumption change that has a UAL component, and these are the payments to pay it off. The gold are for gains and losses, and the green are for benefit changes. And we adjusted these to get a smoother pattern. The line represents the net payment. We adjusted these recently to get a smoother pattern going forward. Under this method, the city would be able to come in and say, for example, oh, we see this payment that goes out for 6 years, but we're just going to pay that off. And maybe they do it with a POB that's 6 years, but maybe they do it with a POB that's 30 years. They could pick and choose whatever they want. And so with this, so if they did take and choose something like that 6-year amortization and pay it off with a POB that they're paying off over 15 years, then you get this kind of pattern where they get a significant reduction, are expected to get a significant reduction for the 6-year period, and then have an increase in contributions for the last 9 years of the POB payments. So, you know, it is a method that's out there. I understand why CalPERS would do this method. There's a certain amount of flexibility that it gives its employers. But I would not recommend this for San Jose just because the board has spent some time trying to set the payment pattern, and I would think there should be some give and take in developing that structure. You could decide that you do want to go with this general approach and figure out which bases to pay off, maybe jointly with the city, and that would work. Then it just has the similar issues to the traditional methods, in that it does provide a short-term payment incentive to issue a POB, whether that's warranted or not. So all those traditional methods have some advantages. The main concern I have with the traditional methods is the short-term incentive it creates to issue a POB. It effectively credits the city in advance for the difference between what we have as the expected return and the interest rate on the POB. And then if we don't actually earn investment returns greater than the interest on the POB, we charge the city for it later. So it works out. We collect everything in the end, but it can be sort of a kicking down the road. And that incentive often overrides the long-term risk analysis. And that's my main concern, is to not have the appearance of that and to not actually create that incentive so that people are doing it because they want the short-term budget relief without really doing the long-term risk analysis. So in order to deal with that, we have a proposed method that is more complex. And so that, I think, is its chief disadvantage, is it's a little bit more complex. The mechanics are, when we calculate the contribution rate, so that the POB assets go into the fund, into the pension plan, but when we calculate the contribution rate, we subtract the amount outstanding on the POB as of that date. So we don't count those assets. So we're calculating something with a larger UAL. And then we come up with the larger contribution amount. And then from that larger contribution amount, we subtract the payment on the POB. And so essentially we're just taking the POB dynamic out of the calculation of the contribution rate. And so initially when the city contributes the POB, their contribution to the pension plan goes down by exactly the amount that they are paying for the POB. And so their total contribution amount does not change. As time goes on, the city contributions will go down to the extent the city pays off the POB, and as returns on POB assets are greater than the interest rate on the bond. So this is the pattern that would come out if we got 6 5/8 all the time. We start out with the city's POB payment, plus they would pay a little bit more to the pension plan so that it actually matches what we have. And then as we get 6 5/8% returns, that goes down. And so they get a net gain over time if we get the 6 5/8% return. They get the same net gain over the whole period. We just don't give it to them up front. We wait till we get the actual returns. Interestingly, if they got a 3% return, which is what I have the interest rate on the bond, the payments are identical, whether they issued the bond or not, because we charge them more, and then as we incur losses with the 3% returns, we generate a loss, and those payments that the city is required to make just match what we did on the plan regularly if the POB had not been issued. Going back to the 0% scenario, the city would feel it sooner. So remember, under the traditional method, they were coming out ahead for like the first 6 years before they started paying more. And then a lot of it was paid after 15 years. Under this method, they'd start paying for it earlier, then they start getting the gains from the 6.625 return versus the 3%, and end up paying less when those gains overtake the initial losses. And there's just a small residual. If they get the good scenario, they still start out at the current level of total contribution, but it goes down rapidly, reflecting those higher returns. So they still get the same benefits. It's the timing of when we recognize those benefits, and it removes the initial incentive to issue a POB to get immediate contribution rate relief. So the municipal advisor talked about a strategy where they would recycle the savings. And I think this essentially formalizes that recycled savings strategy up to a point, in that, we are crediting and reducing contributions as we get those investment returns. So any questions on that and what that method is trying to accomplish?
I have a clarifying question. So what is, I'm still a little fuzzy on what our role as the board for the pension plan is in influencing the decision on the issuance of a pension obligation bond. Do we have to approve this, or is it that the city makes the decision and we're told this is what you get, and we decide how to deploy it?
So there's a little bit of a symbiotic relationship here, but the city makes the decision on whether or not to issue the POB. That decision is often based on how they expect the pension plan to invest those assets and how they expect to be credited on the contribution side. The board's role is to decide how they're going to credit the city on the contribution side for suddenly getting a lump sum of assets and how to invest that lump sum of assets. And so those both feed each other. And I'm not talking about the investment of the assets. That's a separate question, but it does need to get coordinated in this circle. I'm just talking about what we credit for the city on their contributions once we receive the lump sum. And I'm suggesting because of that symbiotic relationship, we consider taking out the incentive of an immediate reduction in their total contribution, counting the payments on the POB. And so that's what this method tries to do, is to remove that contribution level incentive and just focus on the long-term economic impacts to the city.
That's very helpful. Thank you. And just to get my head straight, so we will provide guidance on where we are leaning, and that could influence their decision on what they want to do. Is that how this works?
Right. So your formal role is just to make those decisions on the amortization and the investment. Mm-hmm. But because those may affect their decision on whether or not to do a POB, and we need to consider what their objectives are with the POB. There needs to be some back and forth to coordinate those.
Understood. That's very helpful. Thank you.
So I think I've hit all these points repeatedly. I do want to say this is just to open a discussion. We're not asking for any decisions today, but wanted to get the information out and what our thinking is and get the board thinking and make sure the city knew what we would be telling the board, as well as get the updated outlook out so that people understood how significant the current year's investment returns might be on the outlook that they're using in making this decision. So I would just take any questions you have on this and think of it as an ongoing discussion. And if there are additional analyses that you want to look at, please let me know. But this was just to open that whole discussion. So
I'll drive for a bit, Bill. That was just spectacular. Wow. My head hurts. That's a good thing. So why don't we do the following? Let's let Harvey weigh in first. Kind of where are we in space and time? What's our fiduciary duty? Then I'll go alphabetically through the list of board members except myself. And then I like turn to Prabhu. Then you, Roberto, and then I will go last. There is no vote on this. As Bill says, this is just an opening debate. So Harvey, if you don't mind, Harvey, where are we in space and time with our fiduciary duty?
You make me go first, huh?
Yeah, because you're the best.
Well, actually, Sunita asked a very good question about what's the board's role, and that's a terrific question for me to weigh in on a little bit. But before I do that, I see I'm going to put her on the spot for a second, but not badly, soft spot. I see Laura Wyrick from Makita is still on, listening into this intently, and I wanted maybe to sort of frame this, I wanted to ask Laura some maybe these are obvious questions for you, Laura, but so do I have this right that the municipal bond market is considered an efficient market?
Yeah, I think that's fair.
I mean, in your business, in the institutional investing business, the municipal bond market is one of those things. It's called an efficient market, not an inefficient market, right?
I mean, I would argue, yes, that most public markets, including the majority of bond markets, even though bonds don't trade as easily as equities, are reasonably efficient.
And I'm trying to understand, when we talk about an efficient market, it means that the market prices in the risks to credit issuers in that market. Is that right?
Yes, I mean, there's criticisms of rating agencies and things like that that could be considered, but in general, yes.
And the market will price in its assessment of the city's tolerance for risk when it issues pension obligation bonds. I take it that the market, the institutional bond market, and the credit agencies will do their independent assessment of what the city's creditworthiness is and its tolerance for risk in issuing these bonds, and that will be reflected in the pricing of the bonds. Isn't that right?
Yeah, that's definitely the goal. I think there's other dynamics, not to keep hedging, but there's always other dynamics around demand for, folks like yourselves to put money to work that might impact prices beyond just, very specific risk of individual offerings.
But we would expect the credit rating agencies to do their own independent assessment of the city's tolerance for risk.
Yes, that's correct.
And their ability to take on risk. And is it also true that because these are pension obligation bonds and not general obligation bonds that are being considered, that the market of institutional investors for these bonds know that, they know it's pension obligation bonds, and they can assess, and the rating agencies can assess the city's tolerance for risk in issuing pension obligation bonds as different from general obligation bonds. Do I have that right too?
Yeah, they'll take into account the credit worthiness of the city in terms of pricing them.
Okay, I appreciate letting me put you on the spot because my point in asking you those questions is really to make the point that the city's creditworthiness and its tolerance for risk is not our job. If the city will make its own decision, and we can assume that the city, once it gets underwriting for bonds and gets pricing on the bonds, which reflects the market's assessment of the city's creditworthiness and ability to take risk. And if the city wants to go forward, the city will be telling us what their risk tolerance is. And so we as a pension board don't need to trouble ourselves with, even though we've got a lot of very smart people on our board, it's not our job to try to suss out what we think the city's tolerance for risk is in issuing pension obligation bonds. The market will tell the city what it thinks its tolerance is, and the city will either agree and go forward with them or disagree and not go forward with them. So I want to focus the board then on what the board's role is. And the board's role is to do exactly what the board does every couple of years, which is to establish its asset liability through an asset liability study. It's tolerant for portfolio risk and where it wants to be on that efficient frontier and assessing what the risks it's willing to take to get the returns, the market returns that it expects to get from the risks that it takes. And we do that constantly. I also want to point this out, and maybe this only just occurred to me this morning, but in listening to Prabhu's report of our investment returns, hopefully by the end of June, let's say they stay the same, we're making 20% this year on our assets. That's pretty damn close to what a pension obligation bond would be from the city. We are taking in, I don't know what the exact number is, but we're taking in 25% in 1 year on our assets. Our assets are growing by almost as much, give or take, almost as much as the city is contemplating putting in on a pension obligation bond. And this board will do what it does best in assessing where that money should be invested, where on the efficient frontier it wants to put its risk reward bets, if you will. There's no leverage. Bill knows this. I take great umbrage at the equivalence in these slides of talking about that this is the same as leveraging the portfolio. I want to echo Trustee Sanzeri's comments. This is absolutely not leveraging the portfolio. Taking in $1 billion of new money, whether through investment returns or POB proceeds, is not the same as this board deciding to margin call or to margin or leverage its portfolio. And that really needs to be stated. There will be no recourse against plan assets if the city makes this borrowing. That is very different if the plan trustees, this board, were to decide to leverage your assets, there would be recourse against your assets for leveraging them. There is no such recourse in this situation with the POB. So what the board is doing now, right now, and going forward next year, with the influx of nearly $1 billion of new money, new assets that are coming in from investment returns this year, is exactly the board's role in deciding what to do with another $1 billion that might come into the system from pension obligation bond borrowing by the city. It is the city that would be leveraging its assets, not the pension plan leveraging its assets. So we will do what we need. Our role is not to give the city a choice over how it wants to have this money come into the system. That's your role. Your role is to decide where to apply the money and bring it in, not to take it in dribs and drabs, not to credit it in ways that manipulate how it comes into the system, but to go through your asset liability study, decide what your risk tolerances are, and take this money in, invest it like all the other assets and like the extra $1 billion that came in this year, and we'll move forward. One other comment I'll make is this. We have a slide, I think, I can't remember, Bill, which number it was, that says, well, maybe it's the one right in front here that's on the slide 14 with a 20% return. we're assuming 6 5/8 return over the long haul in this system, and that's our actuarial assumed rate of return. If we're getting 20+%, then you are telling us that we should expect a reversion to mean. That within the next period of time, we should expect an equivalent 13% loss in our portfolio. And I think we need to see that pattern when we talk about the risk analysis to the system. If we're experiencing a 20 to 23% return this year, and you're assuming 6 5/8, then you're telling us that we will have a reversion of equivalent, at least, to go back to that mean over time. And I think that needs to be patterned in these slides as well as we go forward, because, excuse me, I think the board needs to understand that what goes up comes down, especially if it goes up to 20+%. So I'd like to see the board get a little more education on the likely pattern of volatility over time. It might also be helpful for the city to see that pattern as well. But not to extend my stay here, my welcome. Let me just say this. I'd like to see the board take the POB issue in stride. I'd like you not to come up with disruptive, creative, or aberrant approaches to how this prospective $1 billion of income might be treated relative to the $1 billion you just earned in the last 12 months. I'd like to see the board do an asset liability study. You could do it prospectively on the assumption that a certain amount of money is coming in. I'd like to see you go through the same process, deliberative process, documented public process of where your risk return tolerances are. And I'd like you to leave the city's tolerance for risk to the two parties who are better able to assess that. And that is the city and the bond market. And if you'll do that, then I think you'll be clearly satisfying your fiduciary responsibilities to the plan and to all the members of the plan. There is an excellent precedent for the board doing exactly that. There was litigation that came out of the County of San Diego a dozen years ago. We have strong judicial support for a board taking in a substantial influx of money from a single plan sponsor and treating it in the ordinary course, even doing a new actuarial liability study. And in that case, some reduction in plan sponsor contribution rates. But it was done in the ordinary course of their business and not as some creative attempt to match risk or something, or think about the impact on the city's balance sheet, the plan sponsor's balance sheet, as opposed to the balance sheet of the pension fund. So I'd like to encourage the board to keep their eye on our balance sheet and our risk tolerances and our reward expectations, and leave to the market and to the city its assessment of the city's risk tolerance. I hope that's helpful. I'm happy to answer any questions, but I think I'll cede the floor to whoever was next, Drew.
Let me jump. I see Vince's hand up. Let me jump into the board. So there's been this long looping set of emails between Harvey and I. I absolutely echo what Harvey said. And I think the relevant thing that Harvey said was, so you just made $1 billion in the market, and maybe you're going to have another $1 billion dropped on top of you. And so you're a slightly different beast because 5 billion is different than 4 billion. So go back and do your regular thing and say, well, every year you're a slightly different beast. And every year you go back and you look at it and say, what's the asset allocation? What's my appetite for risk? And I think that's exactly right. I would echo what Harvey said is, there's work for us to do. This is, in any case, Harvey's the work for us to do. We got $1 billion more than we had just on our own. So, Vince, I see your hands up. You want to jump in?
Yeah, I mean, just a comment I want to make, and really this was prior to Harvey's comments. I think he's spot on in giving us this advice. My suggestion was, as we go through this process, that we focus on the amortization and actuarial aspect of POBs and set aside any discussion on the investment side and what we might do there, because I consider that to be a very different topic, could be a very robust discussion. And we haven't even prepared our investment consultants to bring together material to help us with that process. So I think it might be easier as we go through in each comment, if we could steer it towards this presentation today and set the investment side and what we would do with proceeds aside for now.
That's probably excellent advice, Vince. So let's go ahead and let me just take a little chairman's prerogative. So let's go ahead and bifurcate this conversation, right? We're dealing with the actuarial side. As Bill says, the key decision there is this amortization formula. How do we do this, right? Bill's given us, gosh, a half dozen good examples. And let's hold off this notion, as Harvey's Vince says, of, all right, well, it's a slightly different beast, so it might have slightly different risk. It might require a slightly different asset allocation, which may imply a slightly different discount rate. And let's hold that part of the conversation. I think that's really, really wise, Vince. So in fact, at the end of this, let's talk about how we'll get to that. But for now, let's try to stay on Bill and the actual amortization. So let's start. So let's start rolling down the deck. Go ahead, Andrew. You want to weigh in on anything? Questions, comments, too, whatever you want to do, Andrew.
Just a comment. I want to thank Bill for this presentation. The way I process things is, I listen. It honestly takes me time to just process it, and I come up with more questions. So anticipate an email from me, calling Roberto, people with further questions. But excellent presentation and a lot to think about and consider.
Good. Sunita?
Yeah, I mean, I was actually going to do a round of applause for Harvey because it really helped me clear my head on how to look at this problem. I guess I'll be very candid about this. And Bill, I learned a lot from your presentation today, but I also, I don't know if this should be done one-on-one or in a board meeting, but I think I'm still a little struggling to understand the amortization options with the lens that Harvey just provided, which is ignoring incentives of the city and really thinking about how it affects the plan. And I wonder if others feel the same way and whether we could have a bit of a relook at the amortization problem without this sort of lens of, are we incentivizing the city to change their schedule in a way which we have no control over what risk they want to take. That's one sort of observation. The second is, I wasn't really clear about Vince's suggestion about ignoring the investment piece, because I think deploying $1 billion of capital at a time is very different than dribbling into investments over time. So I would love to get Prabhu's perspective, either today or another board meeting, on how how does that risk our 6 5/8 return target by suddenly getting a big inflow of cash. And I think that's what Harvey alluded to, but I'm not sure I have a good enough.
You just said what Vince was saying, which was, let's put that in another meeting. Vince was saying ignore it. I think what Vince was saying was that's a whole other subject, and if we get into it today, we might be jumping the gun. I think, right, Vince? That's all you're saying.
Exactly right. Thanks, Drew.
Yeah, but I think there's one sort of slightly nuanced aspect of this, which is, are we obligated to tell the city, if you give us $1 billion today, given where markets are, or in the next 6 months, we might actually risk the 6 5/8, meeting the 6 5/8. Understanding what that risk is something I worry about, I guess. Or is it, maybe I should say it differently. Is it our obligation to inform the city that there is a risk that if you suddenly have this cash flow, that this sort of return we've had is going to affect this? That might affect their decision. I'm not sure what that back and forth is. But
Yeah.
those are my two observations.
I think more more talk, more knowledge is good, and I think Bill kind of said it right there at the end, where he's like, so guys, the future is unknown, but we can do Monte Carlo analysis, we can do stuff, and we can tell the city what the range of possible outcomes are based on the amortization schedule we choose, and that's probably the best thing I think we can tell the city, is the future looks like this probability spread. Good luck.
Comment?
Yeah, jump in, Harvey.
We tell the city this every year before July 1 when they prepay their contributions for the year and they ask for a discount of some amount. This is exactly what we have a policy for, and that affects that discount we give them. If we think we're in mature markets and the market may go down, we put them on notice that there is risk when you put a large sum of money that we have to then put into the market in one fell swoop.
We've got that chart, Harvey, we've been showing them for 7 or 8 years. So I agree with you. All we're talking is we're going to show them a new chart. Same chart we show you every year. We're just, right? It almost feels kind of like we're doing something mid-year that we do every year. Is that kind of what you're thinking, Harvey?
Exactly. Thanks.
That makes good sense to me. Howard.
Yeah. Bill, thank you for that presentation. I thought it was super useful. I actually really like the scenario planning, and I liked, I forget what slide it was. I liked slide 29. It seems like that's where I think we want to be at. And the fact that we can tweak it and show what the impacts are, what the amortization schedule. So to me, I mean, I think that's where we should be headed towards. And I guess my question is, I don't have much experience with this. Is this typically a negotiation? I mean, it's mentioned before. Is this a give and take with the city to make sure that here's what we think and what do you guys, and then come up with some sort of compromise? I mean, I guess that's one question, because ultimately I feel like as a board, we can only control what we know and what we can control. And our interests may not be 100% aligned with the city. And on top of that, you know, we have a duty to our members. So we have to make sure that, I feel like we should try to get to where slide 29 is. So I'm in full agreement with the focus on amortization, but I think to Sunita's point, you know, when you manage capital, just because you have more money, it's not always the best thing. It's just a matter of, you have to be able to know what you're going to do with it. And I agree, you talk about a different point, but another $1 billion just dropped in our lap doesn't make it a slam dunk in terms of how we do it. So I agree it could be in 2 stages. But I thought it was really useful. And what is the timing on all this? Is our timing dependent upon when they sort of figure out when they want to do the POB?
Yeah, I think your timing is dependent on the city's timing. And they're starting through that process, but I don't know when they expect that they could actually pull the trigger and do it.
Yeah, so let me just say something about that, just to give the board a little background. The city is going to the city council on June 29th to basically get approval from the city council on whether or not to move ahead with the POB issuance. Now, the expectations are that the city council will approve it. Of course, if they do not, then this has been a very good education, but it will be a moot point. Now, assuming they do approve it, then the next goal will be to have a joint meeting with the city council and the boards. That will probably happen sometime in the time frame of September. The reason I'm saying that is because clearly what this has shown us is that there are a lot of issues to think about. There are a lot of questions to be asked. And if we want to be ready to attend that meeting with the city council so that both sides have a meaningful discussion, we are going to have to schedule our meetings such that we are prepared to have that joint meeting in September and ask questions and address any issues.
Now let me go ahead and weigh in again with Chairman's comments. So, Bill, gosh, you've just done a great job. So, think about what Bill just did for us. Bill said, I can sort of suggest an answer for you. I could probably suggest 2 or 3 answers. More importantly, Bill said, hey, kids, I built a tool. Any way you want to do this, I punch in a few keys and I can tell you what's going to happen. And so, per Vince's suggestion, and obviously the next thing we need, Laura's probably still online, is Laura and Varys then to build us a corresponding tool on the risk side. As Harvey said, we've taken in $1 billion, we may get another $1 billion. Well, that clearly is an aircraft carrier now, not a battleship, and they act differently in the water. And clearly, just putting in more money impacts how risk works. And so we've set a way to do our discount rate and so on based on how much risk are we willing to tolerate. We've sort of used the same thing every year. And so I say we just run this approach, this 12% volatility thing in and see how the aircraft carrier behaves differently than the battleship. So I'll hold that thought for I said at the end, I'll wrap up. So go ahead, Bill, jump in.
Yeah, just quickly, I want to be sure. I picked $1 billion because it was a round number and simple to use. I don't know that that's what the city is considering. And I think a lot of these issues become more significant the larger the POB is. If it's relatively small compared to the assets of the plan, I'm much less concerned about how we handle city contributions. You are probably much less concerned about how it affects your investments. So we need to keep that in mind. There's just so many unknowns at this point. But we needed to start thinking about these structures and what it means. And what, I think the difference I have in a perspective from Harvey is just being concerned that the actuarial methods are being used to create an incentive that shouldn't be there. And I know the actuarial profession and some boards have received criticism for creating those incentives. So I'm probably more sensitive to those than someone who's just defending in a legal court those incentives. But
well, and I think I would echo what I said earlier is I sat in on some of those task force meetings. Clearly not the city's intent to do that. And I would note, Bill, as you say, it's maybe not $1 billion, but of course it's in an orange box. All we got to do is tap a few keys when we find out the number, right?
Exactly right.
Right. Eshwar, over to you.
Yeah, thank you. So Bill, thank you for the presentation. It was great, a lot of information, very helpful. And thank you, Harvey, for your comments. I've spoken before. I'm in favor of of POBs. I think it will help the city, help the plan. I do echo what both Sunita said and Howard said. I think there is a practical side to deploying a large amount of assets, and Prabhu can weigh in later. In theory, you can say, it's fine. And actually, I would disagree with what Harvey said, which is that if, a plan grew $1 billion, to me, it's not the same as getting an extra new $1 billion because that $1 billion is not invested. Whereas, the $1 billion that it grew is already fully invested. So I would say it is a little bit different. So we need to, especially I think on the private market side, because, if you look at the 6 5/8 kind of projection, you will see that the illiquid markets, are the ones that contribute kind of the 8, 9, 10% kind of returns. So can we effectively deploy a large amount of money and get the same projected returns? I would question that. So that would be that, and we can discuss it at a later meeting, as we said. And there may be a practical side. Now, I know Harvey kind of discouraged this, which is that, well, let's not take it in drips, and pieces. But, maybe, Prabhu and the team would say, if it's $1 billion, give us 200 million a year for 5 years. Maybe that may be easy on the team. So those are my thoughts. In general, I think it's a great idea, but, we should see how we execute it.
Yeah, well said, Eshwar. It's yet another way an aircraft carrier ain't quite the same as a battleship. Yeah, amen. Muyo, any comments, questions, thoughts?
No questions. Thank you to Bill and I really think that Harvey, for me, nailed it. So I'm in total agreement with Harvey. Thank you all for the comment and the presentation.
Thanks, Nick. Dick, any comments or thoughts from you? Questions?
Yes, after all this time, hell yeah, might as well. A couple weeks ago on a Friday at 9 o'clock in the morning, I listened very carefully to that city council meeting and presentation. And I was in a real quandary. After it was all said and done, I said, why don't we get $250 a month cash out of the retirement system and try the lotto? Because I think we had better odds. So it was very confusing to me. But I'm a man of a lot of experience in making money. So I may not have the education in the investment field, but I've been around a long time to know. So it's very confusing. Bill, I want to take my hat off to you because today you did a hell of a job of a guy like myself to help me understand and keep it a lot more simpler. So I was very pleased with yours. And then Harvey, now you know why we can keep on extending your contract with us, because you kept the field goal that put me where I got to go. Keep it simple. Let's get back to our fiduciary responsibilities. What you're saying is let's protect the plan at all costs, no matter what it is. And so thank you very much. Mostly this investment talks, I'd rather watch paint dry, but I can tell you this was very, very good for me, very educational, and I have more confidence in the decisions I have to make. So thank you very much.
Thanks, Dick. Over to you, Vince.
I don't have any comments. I think I asked my questions along the way and I appreciate Bill's responses.
Thanks, Vince. Prabhu and then Roberto, and then I'll do the wrap up.
All right, thanks, Drew. I was going to say a lot of things, but they were all investment related. But at the request of the board, I'm going to probably hold off on a lot of those comments for another meeting. But I do want to say a few things. Firstly, outstanding presentation. I never thought I'd enjoy Bill's presentation so much. He hit the ball out of the park. I mean, it was just outstanding. I learned a lot from that presentation. So thanks, Bill. Just want to comment on a couple of things. Trustee Sunita said, one of her questions suggested, should we incentivize or disincentivize the city? And I suppose we could at least signal our intention. But as Chris Ailman of CalSTRS says, the only way we're going to increase our funding ratio, and when he says we, it's all public pension plans, is to put more money into the system. And this is going to put more money into the system. And so I think it's a good thing overall, right? But let me make some general observations. Harvey spoke about the efficient frontier. People spoke about timing and getting the money in drips and so on. So as I see it, there are 5 factors which will actually determine how we're going to invest the proceeds, right? And we've sort of made the assumption that it's going to be $1 billion, but we don't know. So that's the first factor. The size of the bond issue is going to be significant in terms of how we come up with our asset allocation model. Because the smaller the size, the less impact it has on plan assets, and therefore we can take on more risk. So then that'll actually have a certain impact on risk than a larger issue. Because if it's a very large issue, obviously we cannot take as much risk as, say, if the bond issuance is 200 million or 100 million, then we can just put it all in the most, the entire proceeds can be in growth assets. The second consideration is the length of the bond issue. The longer the bond maturity means we can actually exchange liquidity for returns. So that's something else that we need to learn from our sponsor. It's going to be a 5-year bond, 10-year bond, 30-year bond, because that's going to have an impact. The third thing is the structure of the issue. And this is an important thing. And I think Trustee Menon and some others actually spoke about this. The city may not issue just one bond where we get $1 billion on day one, right? They may actually structure this in a way where it is a series of bonds. So it could be $1 billion, but the series of bonds is we get $200 million every year for 5 years. And that has a bearing on how we invest the assets. And then another very important issue that you all touched on is timing, right? And timing plays a critical role in terms of how we think about risk and how we invest these assets. I wish I had gotten $1 billion on March 31st, 2020. I would have made that $1.2 billion by now, as you've seen. But getting in $1 billion on July 1st, 2021 or January 1st, 2022 might be a very different proposition. And the fifth thing that we should think about is cash flow projections, because future cash flows have a big bearing in terms of liquidity and whether we can exchange liquidity for returns. As we've seen, again, it depends on the length of the bond issue, but as we've seen, we're going to have substantial cash outflows from both our plans about 10 years from now. And that also has a bearing on how we invest the assets. Now, the safest way to invest the assets would be a perfect arbitrage. And that is the city borrows at 3%. We take that, and in a risk-free way, we can invest it in 6% or 5%. Unfortunately, that bond arbitrage is not available, because if the city were to issue at 3% today, for example, and these are taxable bonds, these are not taxable bonds. So we would have to actually go, even to get a decent yield, we have to go deep into single B territory, which is 4.5, 4.6% yield. But the default rate of single Bs is 4%. So we really have to take on a lot of risk in order to get better than 3%. And so we will have to think very hard. We'll need a lot more information from our plan sponsor, and we'll have to think about all these factors that I just pointed out in terms of how we come up with asset allocation. So that's all from me, Drew. Thank you.
Thanks, Roberto. Thanks for Brother Prabhu. Sorry, I actually captured that. I'm going to bring that up at the end. Thanks. That was really helpful. Good, Roberto. You want to weigh in?
Yes, thank you, Trustee and Chair Lanza. So a couple of things. I just want to, well, first of all, obviously, Council did this morning for you exactly what he is in charge of doing, which is keeping you and reminding you about your fiduciary responsibilities. So I thought he did a great job, and certainly you have to, when you make your decisions, you have to think first about your responsibilities to the plan and the plan members. Obviously, there are other issues around that, but that's your primary responsibility. So I think he did an excellent job. I also wanted to remind the board that this whole POB issuance came out of the Retirement Solutions Working Group, which I think was responsible for looking for solutions to improve the health of the pension plans, which to me translate into the fact that the main reason for it is to improve the funding ratios of both plans. Obviously, there are secondary effects to doing so, but I think the overriding factor here is improving the health of the plans and therefore the funding ratio. Third, I just want to let everyone know, I just mentioned the city is going to be going to the City Council on June 29th. Because they need to get a general approval, they are going to be, I believe, asking for an approval to issue up to the full unfunded liability, although there is no intention of doing that. But they want to make sure that they get that kind of approval if, in fact, the City Council does go ahead with the validation process and issuance for the POB. And then as they go through the process, they will decide not only the full amount, but they also have to decide the split between the Fed plan and the police and fire plan. Third, the City Council gave the city staff very specific responsibilities to make sure that they work with ORS staff and the boards so that we can schedule a joint meeting of both parties. I can tell you that I have been in communication with city staff, and I just want to make sure that I emphasize the fact that transparency and openness on these discussions and when we do get to the joint meeting is paramount to have a successful process. I think ultimately, Council is correct. You know what your responsibilities are. I think that you want to make sure that when we go to that joint meeting, you can answer city council questions. It does not mean that you have to consider what are the risks that they're looking for or how they should be investing the funds, but that you should have answer to these questions and let them know how is it that you see the boards moving forward in this process. What are the decision makings that you will be making, and what are the things that you're going to be thinking about? The reason I'm saying that is, even though you have your responsibilities for the plan, we want to make sure that we work together with the city council to give them the data and information they need to make an informed decision from their side, just like you want to ask the right questions to the city council and the city staff and your staff from RS, so that you have the data and information that you need to make an informed decision. So again, and I want to close it by saying, obviously, I think Kyron and Bill did an excellent job. I know the city staff stand ready to work with the boards and with the RS staff to make sure that we keep a line of communication open. And I just can't emphasize enough how critical it is to go to that joint meeting with the city council ready to know the data that we have so we can answer questions, but also to go and be ready to ask the information you're looking for so that you can make informed decisions. So with that, Chair Lanza, I'll turn it over to you. Thank you.
Thanks. So this is interesting. I actually think we've sort of all sort of headed in the same direction. So let me see if I can sort of summarize this. So clearly part of this is this new thing, the slide that's in front of us right now, where a POB requires us to set an interface to the city on how this gets amortized, right? And Bill, God bless you, Bill, has said, guys, I think I've got a tool here. We can figure this out in real time. Roberto, we can bring the city council. City council can say, well, what happens if X? And Bill can go click, 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 clack. Well, I think this is what will happen. And Vince, I think, has rightly said that let's bifurcate this. Okay, we've got this. That's the actual amortization side. Now, what is the investment side, the asset allocation discount rate side? And Harvey has rightly said, I think we all agree, just treat this like any other year, but yeah, it's a different beast. You just made, I think that's why Harvey said that you just made $1 billion, you might get $1 billion added. And Eshvar and then Peru said, real quickly, guys, just off the top of my head, well, the size is going to impact a bigger portfolio. What's the bond duration? What's the structural bond? Maybe is it laddered or not? What's the timing? And guys, how does this cash flow and liquidity? So my guess, right, Roberto, the rest of the board is we should ask, and I see that Veras and Makita are both on, we should ask Veras and Makita to come back in August and say, and we'll just pick a number, guys. Maybe you can sort of parameterize that too. Take the portfolio as it was at the end of this fiscal year, add, say, $1 billion from a POB to it, and tell us how the aircraft carrier that battleship has now become is different. If we apply the same risk criteria we always have, does it have a different metric, right? So, for instance, and Harvey and I went back and forth on this. So, one of the risks Veras does is a shock risk. What's a 20% downturn in the market do? Well, a 20% downturn in the market to a $6 billion fund is a bigger absolute dollar loss than it is to a $4 billion fund. It's almost an extra $500 million loss. That may or may not have an impact on the city and on our operations, but that has to be asked. So I think Harvey's right. Just ask it, Drew, like as if you had a year where you made $2 billion in the market. How do you deal with that? So, right, Roberto, is that your sense too, is to ask Veras and Makita to come back at the August meeting with that?
Yes, I mean, you want to have as much data as you want, not only from the actuary, but also from the investment side of the equation. So yes, absolutely.
And then is it your sense, Roberto, we've got this from Bill. If we get that from Veras and Makita, what else do we need to be ready for a meeting in September with the council, do you think?
I think you just touch on those issues, and so did Prabhu, understanding the bond issuance is the ladder, as you said, what kind of structure they're looking at, how much are we talking about? And then I'm assuming the city is going to be asking you, what are you going to do with the money? You know, what are you going to pay off? And, you know, those are your choices and your decisions. But I think the key issue in all this process is to have an open line of communication. You don't have to agree. You just have to, both sides have to have the information that each other needs to make an informed decision.
So then let me ask you, Prabhu, if you wouldn't mind interacting then with Veris and Makita. So the presentation we see in August is not just their presentation, but it's yours as well. It's the whole holistic thing. Feel free to loop, Eshvar in, loop me in if you want to, maybe you want to, but that makes sense, right, Prabhu?
Yeah, it does. Drew,
Yes.
we'll be happy to do that. And of course, I look to the sponsor. I'm sure some of them are listening into this meeting for more information on the bond issuance.
Yeah, great. If floor is open, does that make sense to everybody? Anybody want to make any other suggestions?
I had a question. So are we essentially saying we're going to go with Bill's recommendation on the amortization, or are we going to, before September, reconvene on that?
No, I think we'd have to reconvene.
Okay.
I think Vince, I was really smart. What Vince suggests is there's two giant pieces. There's the amortization piece, which is giant, and there's this asset, big aircraft carrier piece. And so I think let's do both those separate, and then see, maybe we can put them together in August. I'm guessing the good news is, soon, even having moved the meeting from September 2nd to September 9th, we probably get 2 more board meetings before we meet with the council. Is that council meeting on the calendar yet, Roberto?
No, Drew, it is not. The city staff is working with the city council. It will be, the meeting will be scheduled in one of those study sessions that they have, which is outside the regular Tuesday board meeting. And, I had a conversation with the director of finance yesterday, and our expectation is that it's more likely to be in September. And so I'll certainly keep that line of communication with her. If you feel that it will make sense and we have to look at the timing, that is later rather than sooner, meaning even if it's September, it's late in the month, I will certainly share that with them.
Why don't you go ahead and let them know second half? That kind of makes, I see where you're kind of going with this unit. So we've now done the amortization. August board meeting, let's do Prabhu and Veris and Makita. And then that September board meeting, let's see, as you're saying, Sunita, if we can put all these pieces together and make sense out of the greater whole. Makes sense, right, Sunita? Yeah, perfect. I feel the same way. Anything else anybody wants to comment on?
Yes, I just wanted to let you know, I think the city is thinking right now is not a hard day, but possibly September 30th. So that will give us
a
good time. Yes.
Yeah, and Roberto, have they given you any sense of how much would flow into police and fire from a POB? They're really noodling on that right now.
I don't even know that they actually have any idea yet on the amount. I think they first have to settle on how much they want to float, and then they'll make a decision on how that's going to be split. Yes.
Yeah. I'm guessing too, Roberto, based on your thing about transparency and openness, that you'll let them know, some of them watching now, that we are developing these tools, and of course we're very happy to share these tools with them, right?
Yes, I'll make sure that they know, but as you said, they are actually watching and listening to the discussion. So everything you're saying, they are aware of it, and I promise them, and I just want to let you know that we will make sure that we keep the line of communication open and share whatever information needs to be shared. The last thing that we want is for someone to come down the road and blame their decision on not having the right information or not having transparency or no one provided the information they needed. And so not that could not happen, it could still happen, but we want to make it as difficult as possible.
And I think the firewall you've established, Harvey, makes our job a lot easier too. We can share the tools, we can do stuff, but they make their decision, we make ours, and we're joined together by this shared set of tools, maybe that says, well, this is the math. You put it in 1 billion, you put it in 2 billion, we get the same answer you get because we're using the same tools. Any other comments or suggestions?
Yeah, if I may, Drew, just one. On behalf of the board, I think it would be very helpful if we could humbly ask Bill to come back with what a baseline would look like of treating this under our current policies as an actuarial gain or loss that we amortize in the ordinary event as, let's just say, whatever the amount is that we're going to assume treated as an investment gain and would be applied under our current policies against the various amortization layers as we would in the ordinary course. I think it would be very helpful for the board to see that baseline if we use our current policies in terms of how this would apply against the amortization of the unfunded liability. And then any variations on that could then be measured against what that policy is.
Does that make sense, Bill? That makes sense to me. That makes sense to you, Bill?
Yeah, we set it up as a separate model, but I think integrating it with our normal forecasting model so that you can see the effects and change the amortization policies in there and integrate it with the additional investment returns makes sense.
Is that it? All wrapped up? Let's go ahead and take a 5-minute bio break and we'll reconvene at 12:15. And Roberto, do you want to set this last item on the main agenda up and kick it off?
Yes, thank you, Chair Lanza. So I just want to applaud your board today because there's nothing more exciting than jumping from having a sizable actuarial discussion to a disability discussion. So you're all for a treat. Again, I have asked our new Disability Council, Ross Riqueta, this morning, as well as your board medical advisor, Dr. Susan Tillman, to provide you with an educational presentation on our disability process and disability requirements, and give you some background and education on really how is it that your disability committee and your board has to think about when making a decision on whether or not a particular member or applicant is disabled. And so now I know some of you, like Trustee Santos and Lanza, obviously from the Disability Committee, are well versed in that area. And then you have Trustee Sunseri and Muyo, who have a lot of experience, and to some extent Andrew as well on dealing with disabilities at the board level. But we also have trustees that are newer to this kind of exposure, like Sunita and Howard and Eswar. And so I just thought it was pertinent to bring this item back. We are very sad to see Dr. Truman leave us. Her last day is going to be June 16, which is another reason why I requested this training to take place today, so we can take advantage of having her present to you this morning on the disability process. And so, you know, they both have a presentation, again, Ross from the legal standpoint, and then Dr. Susan Tillman from the medical standpoint on helping you on the disability process. So I encourage you to really ask questions and engage as much as possible, especially those of you that are newer to the board and you are probably correct, have less exposure to the disability decision making. So with that, Chair Lanza, I'll turn it over to you. And what we would like to do is to begin the presentation with Council Riqueta, and then after Ross completes his presentation, then go to Dr. Truman. So thank you and welcome both Ross and Susan. Thank you for being with us this afternoon. We appreciate it.
Great, thanks. Take it away, Russ. You're on mute, brother.
Hi, it's a pleasure to be before you today. I will do my best to comply with Roberto's strict injunction to be focused and as brief as possible, but please ask questions whenever you'd like to. I have been fortunate enough to serve as your disability counsel for quite some time now, and so I think I'm in a position to hopefully offer some helpful comments. As you all know by this point, there are two disability benefits that you administer. Non-service connected disability, that's relatively infrequent, and a service connected disability, and that's where most of our time is spent. In deciding these kind of cases, as with respect to many of your other duties, the provisions of the San Jose Municipal Code control, and obviously it's part of your fiduciary duty to comply with those provisions and implement them. So in terms of disability, even though you'll come to see a fair number of workers' compensation reports, perhaps, the workers' compensation statute and the law developed under it is not what's applicable to you. It's instead the provisions of the San Jose Municipal Code. And before diving into those requirements, just want to provide you two overall perspectives when these kind of applications come before you. Number one, the burden of persuading you that the requirements of the municipal code have been met rests with the applicant. The burden does not rest with the retirement staff. And similarly, when you consider these applications, you're not to give the benefit of the doubt to the applicant. So the burden's on the applicant. Now, the primary provision of the municipal code on the big picture issues on disability applications is set forth in 3.36910, and I've attached it to the end of my PowerPoints. But there's two primary concepts in that section. One, incapacity, and by the way, the municipal code makes incapacity and disability synonymous terms, but I think it's more helpful to think of it in terms of incapacity, and I'll describe that in a little more detail later. So incapacity is requirement number one. The second major requirement on a service-connected disability is service connection. Now, let's jump to a little bit more on incapacity. So one of the elements is, hey, incapacity when? The usual relevant date for the whole focus on incapacity is the applicant's date of separation from employment. Not always the case, but that's the, by and large, the date that we determine incapacity. So looking at incapacity, we first look to see what's wrong. In other words, what is the disease or injury? And that requires a diagnosis. And you'll be surprised in many cases, there aren't diagnoses come before you in the medical reports. So there has to be a diagnosis, and that diagnosis has to indicate an injury or disease that's permanent or of extended duration. And by the way, one little footnote on that, if the applicant has not as yet tried a reasonable treatment option, then the applicant is not permanent. By the way, surgery under at least related case law is not considered a reasonable treatment option. So there has to be an injury or disease, and that injury or disease has to have occurred while the applicant was a member of the system. So there's a sort of a timing consideration. And as a related concept to that, the injury or disease could be pre-existing, but if that injury or disease, like the person comes in with a back injury and is nonetheless hired, if something happens on the job that aggravates that condition that the applicant came into the job with, that still satisfies this requirement of occurring on the job. So right now we have a diagnosis, we have an injury, we have a disease. It occurred while the applicant was a member of the system. What next? And we're still on incapacity. Well, we're now really to the $64 question. Is the applicant, due to that disease or injury, unable to perform the duties of his or her position? And usually that inquiry is divided into two sub-elements. One, are there work restrictions provided by doctors? And number two, is the department unable to accommodate those work restrictions? If the department says, oh yeah, the applicant has those work restrictions, but that's fine, we can provide them permanent duty, it has to be permanent, then you can't grant the application. The person doesn't meet that requirement. But most of the cases that come before you, the department says we can't accommodate, so that element of incapacity is satisfied. Now, the bottom line again is, as you may have already gotten a sense, a lot of these issues are discretionary issues. They're not necessarily bright lines. So you have judgment on any of these. Now, as in any kind of discretion, you can possibly abuse your discretion. But another way to say this is there's not necessarily a single right answer on any application, which just highlights the difficulty of the responsibility imposed upon you with respect to these applications. Now, in a final application on incapacity is that you have to base your decision, exercise your discretion on medical evidence that is competent. Well, you're going to find out soon enough, and many of you either already know it or have guessed it, medical reports can conflict and they can come to opposite conclusions. And then you have the difficult responsibility of deciding which medical report is more persuasive. In other words, which one you find is competent. And they can differ on their internal logic. They can differ on the expression, their understanding of the medical history of the applicant as reflected in their reports. They also differ on to what degree they include a detailed discussion of imaging studies like MRIs, if MRIs are appropriate to the disease or condition at issue in the application, and also their citation and use of current medical literature. But ultimately, you have to review them and decide which you find more persuasive. Depending on what is presented to you, in terms of competent medical evidence, at this point, I'll assume we have found incapacity, that the applicant is unable to perform his or her duty as of the relevant date, usually separation of employment. That leads us to the next issue, and that is service connection. And under sort of appropriate and relevant California Supreme Court precedent, that issue resolves around the question of whether the applicant's employment, either the police or fire department, and here are the sort of magic words from the Supreme Court decision, contributed in a real and measurable way to the incapacity. And further court decisions have told us that that contribution, yes, it has to be real, it has to be measurable, but it doesn't have to be the main contributor to the incapacity or even a primary one. It just has to be a substantial one. And probably many of you seated there are already getting annoyed at the vagueness of these terms, but unfortunately, those are the conceptual categories that the courts have given to us. Now, so it has to be so employment has to be a substantial contributor. And the inquiry there is partly weighing, in many cases, non-work factors that may have contributed to the incapacity against work factors. And again, there's no real machine or device that helps do that weighing, but that still has to be done as best as we can do it. Ultimately, a real contribution means actual and concrete, which again is still somewhat vague, and measurable can safely be interpreted to mean there has to be a basis in medical fact or a reasonable medical inference. And so that's service connection, a real and measurable contribution. Now there's again, a related concept for applicants who have a pre-existing condition when they come on board and they're hired by the city. So there, the service connection inquiry is, did the applicant's employment aggravate in a real and measurable way an underlying condition? But it's still the focus on real and measurable. Now, some of the applications that come before us are fairly simple, but some are difficult. And often the difficult ones is, from an outsider's perspective, something happened on the job, but it doesn't seem that major. So the difficult inquiry, depending on the fact situation, is, did that work event that seems to an external observer minor contribute in a real and measurable way to the incapacity? Or, which is often the case with respect to certain diseases or injuries, did the minor work event merely reveal or light up, as it's sometimes termed, what is otherwise the natural progression of an underlying disease condition? And the applicant would have had the same symptoms, even if that applicant had never worked for the police or fire department, because the applicant unfortunately has a disease that gets worse over time. Now, obviously, deciding that, whether it's a real contributor or just revealing the progression of a disease that's ongoing, is a difficult factual determination. You'll receive medical information and medical advice on that, but ultimately it's your call. And then just one last point before turning it over to Dr. Tierman. Dr. Tierman has done a wonderful job of educating me and perhaps the committee members that medical knowledge changes, and that what appears to be a certain element of a customary medical concept or medical diagnosis changes over time as medical knowledge expands. And so the board is well served by a medical advisor such as Dr. Tierman, who is quite current on the evolving state of current medical knowledge and provides that information to the committee. So this is really all I want to say. Citing many applications that will come before you are not difficult, but quite a few of them are. And often it's helpful to recall that the burden of persuasion, the burden of persuading you that the applicant is incapacitated and that the applicant's employment contributed to that incapacity in a real and measurable way. The burden of showing that's on the applicant, and ultimately you have the discretion on all of these applications. Thank you. That concludes my remarks.
Thanks, Ross. Go ahead, take it away, Dr. Chairman.
Thank you very much. Hopefully my slide deck will get on pretty soon, but first I just briefly want to thank the Police and Fire Board for the opportunity to serve you and the City of San Jose in retirements once again. I have a long history with the city and it really saddens me to have to leave. But, you know, it's time to give to the next generation of leaders in this field. So thank you. It was an honor and privilege. And also it was an honor and privilege to work with all the members of the retirement staff. They have been unbelievably helpful and supportive of me.
We're going to miss you, Susan. You've been an absolute gem.
Thank you very much. I miss you guys. I'm going to take it over from Russ's presentation and really talk to you about what you should really expect from your new medical consultant. Fundamentally,
Susan, can we pull that presentation up, staff? Sorry, Susan, go ahead.
Oh, no problem. Thank you. There were two questions that really need to be answered, and it is the medical consultants. Really what they need to do is answer these questions. And the first one is incapacity. And incapacity is really to see if there are objective measures in the patient and on imaging studies that someone is incapacitated. Because if they're incapacitated, then the doctor can talk about work restrictions. If there are no work restrictions, then there is no disability retirement, because even though they might have had an injury on the job, they're able to do the job. In most of the cases in police and fire, incapacity is less of an issue. So after the medical consultant answers that question, the doctor needs to consider causation. And it really is, are the injuries and illnesses listed by an employee on the retirement application work-related according to the San Jose Municipal Code? Next slide. Now, what does the medical consultant receive when they start reviewing the forms? There are accident reports. When someone has an injury on the job, they file an accident report with the supervisor. Workers' compensation forms. Also workers' compensation documents, including treating physician reports and also medical legal reports. And they're called usually AME, Agreed Medical Examiner, or QME, Qualified Medical Examiner reports. Retirement Services also requests a report from a consulting physician to give a report. This consulting physician usually belongs to a big group that does this part-time, and they are usually a treating orthopedic surgeon or neurologist, etc., who has experience in writing workers' compensation reports. Next slide. The challenges that the medical consultant has, and also the IME from the Retirement Board also has, is the medical records are not always complete. Also, the IME from the Retirement Board usually writes workers' compensation reports that follow different rules. I would say less than 1% of their reports are due to Retirement Board issues. And
Susan, it's Roberto. Could you remind the board what IME stands for, please?
Oh, sure, no problem. Independent Medical Evaluation.
Thank you.
And different municipalities have different rules on how they determine work relationship according to the retirement rules. It is difficult for the IME, who's a practicing physician, to shift gears because retirement reports are done substantially less frequently than workers' compensation reports. The medical records are also by the IME in that group are often reviewed by a medical assistant who writes the medical review portion of the report. And if anyone has ever seen workers' comp reports, the stacks are about this high. So we're asking a person who does not really have a medical degree to cull through those medical reports and write down the pertinent things. Then the IME who is reviewing these may miss discrepancies in the medical record or things that have changed in the medical record because the medical assistant really can't know what's pertinent or not. Next slide, please. So let's go back to incapacity. The first thing that the medical consultant that is writing your final report should do. The definition is a marked loss or deviation in physiological function, psychological function, or anatomic structure of the body. These absences of being able to do something like you can't lift your shoulder above your hand above your shoulder, etc., are used to determine work restrictions. Incapacity consists of three factors. The first one is risk, the second is capacity, and last and somewhat least is tolerance. We'll define these now. Next slide. What is incapacity? Number one, especially in police and fire, what is the chance or likelihood of harm to the patient, co-workers, or general public if they continue the job? It is also something a person should not attempt because of greater odds of injury or physiologically cannot do due to some problem in their body. Next slide. So capacity is the patient's current ability. It includes strength, flexibility, and endurance. And the board must agree also, another term, that the employee has reached maximum medical improvement before approving any disability job restrictions. Next slide. Maximum medical improvement occurs when an injured employee reaches a state where his or her condition cannot be improved any further, or when treatment has reached a plateau in a patient's healing process. So if someone is just tooling along for months and months and not getting better, then they've reached medical maximum improvement according to disability evaluators. Once MMI is reached, the treating physician is basically saying that there is no other reasonable treatment that can be done to help the patient improve. Therefore, the work restrictions that were temporary are now permanent. Next slide. So then You want to ask the consultant and whether they answered the questions of the need for and type of work restrictions based on an objective is the most important word. Again, was there a risk of substantial harm with work activity? And this is also very important, not only employees self-report of pain and ability. Was the patient able to do the essential functions of the job based on ability, not only what the employee states that he or she can do? If there is substantial harm and there is objective evidence of loss of function, then there's impairment and work restrictions are indicated. If the answer to the above is no, and someone says, I have back pain and I can't do the job, but their physical exam is pretty good and their x-ray studies are pretty good, then the medical consultant needs to look at a concept called tolerance. Next slide. Tolerance is basically subjective complaints on the ability to do the job. An employee states he's unable to perform the job, again, despite lack of objective evidence and loss of function. Employee states he can't do the job because of subjective complaints of fatigue and pain. And you see this all the time. The employee will say, I can't sit more than 15 minutes, I can't walk more than 5 minutes, et cetera, et cetera. The problem with fatigue and pain, even though they're real, they're not measurable. And that goes back to what Russ said, it has to be measurable. If the medical reports in IME give work restrictions based only on subjective complaints without meaningful objective findings to corroborate, the medical restrictions are then based solely on the employee's report of impairment. If the medical consultant believes that there still may be valid work restrictions, then it's up to the consulting physician to explain his or her reasoning behind the need for work restrictions based on tolerance alone. One of the things most doctors will say is, it is my medical opinion and you're not a doctor. Or years of experience, I've been an orthopedist for 300 years, is not a real and measurable reason to accept work restrictions. The Board of Disability should ask questions of either the medical consultant or, if need be, the IME for more clarification if they don't understand the reasoning behind it. Next slide. So then, if you answer question number 1 and you determine there are work restrictions, you have to determine causation. And causation is cause and effect. Was this injury work-related? And did the applicant's employment with the city contribute in a real and measurable way to that incapacity? Next slide. Accidents are easy. If an employee falls, breaks his arm and leg, there's no problem. They fell, they broke their arm, that's the cause. However, a lot of times we have illnesses or cumulative trauma. They're more difficult to determine causation. The doctor must determine if there's a real and measurable risk, if the disease is characteristic of and peculiar to a particular occupation. Now, some of these are easy, and the first one is coal miner silicosis. That's been established, no problem. A coal miner with a particular lung disease is automatically granted disability. Cumulative trauma, much harder to ascertain. For example, is someone with carpal tunnel, is it related to work or other well-known risk factors that have been proven, such as pregnancy, obesity, and diabetes? Next slide. Did the medical consultant make a true assessment of work-relatedness? Number 1, did they make the correct diagnosis? If you don't have the right diagnosis, guess what? You can't determine work-relatedness. And Russ alluded to that in the past. You will have many doctors' reports, especially in the back. One will say musculoskeletal pain, others will say degenerative disc disease, other people will say sacroiliitis. And even with the same doctor, the diagnosis will change as different therapeutic treatments do not work. Did the doctor attempt to assess the evidence of exposure, or did the doctor totally rely on the patient's assessment or those of other consulting physicians? The doctor needs to know what the person's job is and how much time they do certain things. A police officer is not, although now it seems like they might always be in shootouts all the time. That is not the major portion of their job. They also rotate. They're not on patrol 100% of the time. Does the doctor understand the workplace? Private doctors who are not in occupational medicine typically have no idea about anyone else's workplace. Did the doctor consider factors outside of work in the prevalence of the diagnosis in the general population? A lot of people ski, dirt bike, do all sorts of things which would be considered, quote, cumulative trauma. But because they enjoy it and they know the risks, do not see it as a problem. I rarely see an evaluating doctor talk about outside work factors. They also rarely talk about the prevalence of a diagnosis in the general population. If 60% of police officers get back pain, but 60% of the general population have back pain, it means, yes, police officers can get back pain, but you have to have a reason because they're no different than the rest of the population. Next slide. Other factors to consider, and I'll sort of skip over this because Russ really stated it very well. Was it aggravation, which is a permanent worsening? And the example I use, employee with osteoarthritis acutely herniates a disc while lifting at work. Exacerbation, that's a temporary worsening of a pre-existing condition that happened at work. Someone has a horrible x-ray after lifting a 20-pound bag. There's no acute changes on MRI, and we all know that it takes 10 to 15 years for osteoarthritis to show up on x-ray. That x-ray evidence is old, it's not new, it's not acute. Next slide. The patient is often confused why something is not service-connected if the pain began at work. They will say it never hurt before. And even though it never hurt before, that does not necessarily mean objective aggravation. It can mean that a causal relationship has been erroneously assumed from a merely sequential one. And a kind of silly example I'll give is a black cat. A black cat walks by you and 5 minutes later you run into a car. Did the black cat cause it? After all, black cats are bad luck. No, it just happens that they're two events that are temporally or time related, but not causally related. Next slide. The problems with temporality, and I think this is a really important concept. A woman was walking upstairs at work and felt pain in her right knee, never felt the pain before. There was no injury, she didn't twist, she didn't fall, etc. X-ray shows knee osteoarthritis. The consulting physician needs to tell you whether walking upstairs was the root cause of her pain, or is it really the underlying osteoarthritis? Because she has osteoarthritis, she's going to have pain walking up the steps. It didn't cause her pain. It happened at work, but did not cause the knee pain. Next slide. Other considerations. Nearly 100% of medical records are from claims that have been accepted by workers' compensation. I would say essentially 100%, otherwise they wouldn't be there. Workers' compensation laws and regulations are quite different than the San Jose Municipal Code for retirements. Incidents that happen at work are almost universally declared work-related in the workers' compensation system. When the first episode, and fill in the blank, back pain, shoulder pain, knee pain, etc., occurs with normal activity at work or minimal trauma at work, the doctors assume that this was intended to be work compensable, even if they understood it was not actually caused by the work exposure. Next slide. Did the doctor consider progression of the underlying disease? Again, osteoarthritis can be present on X-ray or MRI scan for 15 years before pain begins. Progression, which is an important concept. Someone has an underlying condition that is below pain threshold and over time becomes painful. If the pain begins at work, an employee may believe the activity that they were actually doing when the pain occurred caused the disease. Next slide. Another example is my hands go numb when I type on a keyboard. Therefore, the keyboard is the cause of my carpal tunnel syndrome. All epidemiologic studies, despite 30 years of research, have shown insufficient evidence between typing and carpal tunnel syndrome, and most doctors do not believe that it causes it. Do we grant service connection? What if she's also obese, knits, gardens at home, and has diabetes? How does that factor in? Next slide. I'm just going to quickly talk about mental illness causation, because these are very, very difficult cases, but they should be approached similarly in most ways. The claimant believes that some work or experience caused his depression, pain disorder, PTSD. In these cases, 100% of these need to have an independent evaluation in these cases. And the reason for this is that it is ethically against the rules of the professional societies, especially the psychiatric and psychological associations, that treating clinicians deal with forensic issues such as causation. They can talk about diagnosis, but not causation. And that's because the therapeutic relationship is so important and could break if the person deals with this issue. I don't want to say honestly, because they do try to. Next slide. The steps, again, are similar to physical trauma or illness, but it's more difficult to establish a definitive diagnosis, as there is no scientifically validated method for diagnosing specific mental diseases. It's a constellation of symptoms. Epidemiological evidence is lacking in the literature that links mental illness to a definitive cause. So the claim must be grounded as much as you can in credible and reliable scientific findings that the specific claim caused and is a significant risk factor for the diagnosis and is a reason for impairment. Next slide. Modern standard for mental illness diagnosis has to, in these reports, comply with the standards of the American Psychiatric Association, and specifically the DSM-5, the Diagnostic and Statistical Manual of Mental Disorders. The evaluation should include general medical records, mental health history and records, employment records. All these records are critical. Next slide. No critical report should rely solely on the reports of the examinee. There needs to be a specific valuation in all cases for personality disorders. Personality disorders is a very pervasive form of mental illness that reliably leads to stress or disability, regardless of whether an occupational illness occurs. And when evaluating for impairment, should use established analysis and should, again, not use evaluators' impressions or clinical experience. Next slide. So, in general, the medical consultant has the responsibility to the disability committee and the board to review each case in detail, look at all the reports, and also have a knowledge of the job. They need to use medical evidence, including the medical literature, to give reasoned opinions on impairment and causation. Next slide. I think I'm going to skip this. You guys had a long day, but what I really want to say is that medical literature is not created equal. Quality and reliability of a study is based on proper study design, and most doctors really do not have courses on how to read the medical literature, especially the older doctors. Most medical literature on work-related causation is based on epidemiologic studies, which study groups and not individuals. Next slide, sorry. And they are subject to a lot of problems. They can rarely determine cause, only association. And there are a lot of times there's a lot of bias, how subjects were selected, the response rate, and how accurately was the exposure and outcome measured. There is a high chance, especially in employment studies, where if you have, I'm making up a number, 100,000 firefighters in the country, and you have a case sample of 100 people, the outcome could be due to chance only and not because it is real. It's the same thing as if you flip a coin 100 times and you get 70 heads. That does not change the fact that it's still 50% over, although in your case study, you would say it's a 70% chance of getting heads. And again, you have to look at confounding things, and that depends on the biology of association. You can get cancer from certain substances, but there's dose response. If you have very little, there is a threshold for cancer, and there's also a time delay. Next slide. So basically, you need to rely on the medical consultant to tie everything together to give you the best reasoned conclusion. The answer to service connection, as Russ has said, is not always black and white, and work restrictions also the same thing. Work capacity can be measured, but fluctuates depending on many factors. And we know that in of ourselves. Some days we can exercise like crazy, and sometimes after 15 minutes, we're exhausted. Medical causation can be difficult to determine, especially in chronic cases such as osteoarthritis, cancers, and repetitive motion. These are all diagnoses that are extremely common in the United States population, and we have to drill down and see if they're also common in the population we are talking about. And that should be it. So.
Great. Yeah, thanks, Doc. Floor is open. Before you jump in, let me make the note that in 4 minutes, we're going to take a 5-minute break while they swap out the videotape. But for 4 or 5 minutes right now, floor is open if you have any questions for Counselor or the doc.
I don't have any questions, Drew, but I wanted to first, obviously, I'm hoping that first that this was a reminder to some of you trustees that have had some experience on analyzing disability applications over the last few years. But more than anything, I know it was quick, but I hope it was at least an initial education on what you should be thinking about. And I would encourage you to keep these 2 presentations handy to those trustees that have joined your board over the last couple of years and have less exposure to making disability decisions, so that when that issue comes up, you are better equipped to either make a decision or at least to ask the right questions when an issue such as this one will come up for discussion at the board level. Again, if you have any specific comments or questions, feel free to ask. And in closing, I just wanted to obviously thank both of you presenters, Councilor Riquera, for taking the time this afternoon to present the legal implications of the disability process, and also to Dr. Treeman. You already heard from not only Chair Lanza, but also Dr. Treeman. It has been a real pleasure working with you over the last 4 years or so, and maybe even longer, I don't remember exactly. You really have done an excellent job with the committee, and you definitely will be missed. I know we have to cut off at 1 o'clock, so I just wanted to thank you on behalf of the board and the members for all your hard work and your support. So best of luck to you, Susan. I hope you enjoy your retirement. Thank you very much.
Thank you.
I don't know, Dick, if you want to say a few words about Susan. Got a minute or two.
Yes, I do. Thank you, Mr. Chair. Well, first of all, we got to make sure that all board members and potential board members that come on get this in writing. You know, like in investments, we always ask for the experts. We want the best advice we can get. Well, Rush Raqueta has all kinds of experience and has been a great panelist. He's been our attorney. He's worked for various plans, and he brought all that experience. And I always value his input. Dr. Tierman is the same way. We've worked together for many, many years when we became an independent doctor on the retirement system when we didn't have that. She has enhanced our system. She's very sensitive to police and firefighters, has always been fair, and brings in examples and makes people do their job to make the proof and evidence available. All I can say is I'll say more Monday, but Dr. Chairman, thank you for your service. I look at you as a wonderful doctor and a friend, and so the best to you.
Well said, Dick. I think that's good. Let's go ahead and take a 5-minute break. Reconvene at 1:05. Thanks, Susan Borash.
Bye. Thank you.
Thank you. Bye-bye.
Again, we'll take service determinants, deferred vested, and then in memoriam, and then we'll shift to committee reports. I really appreciate the board's patience. I think we'll get you out of here by 1:30 or sooner. All right, service retirements. Douglas E. Amaro, firefighter, fire department, effective June 10, 2021, 25.89 years of service. Jared Middleton, fire captain, fire department, effective June 12th, 2021. He's got 25.34 years of service. Ken Muto, police officer, police department, effective June 12th, 2021, 25.22 years of service. And Thomas Reed, fire engine, fire department, effective June 26, 2021, with 31.56 years of service with reciprocity. Do you have a motion to approve those?
So move, Santos.
Do I have a second?
Second, Gardenier.
Right, I've got a motion by Santos, second by Gardenier. Let's go around the block. Andrew.
Aye.
Rita.
Aye.
Howard.
Yes.
Ishvar.
Aye.
Puyo.
Aye.
Santos.
Yes.
Vince. Vince? Ooh. Vince, we can't hear you. It's fine. This is Chair Lanza. I vote aye as well. That takes us to deferred vested. Jared M. Jesser, police officer, police department, effective July 30th, 2021, with 25.35 years of service with reciprocity. Philip J. Mancini, police officer, police department, effective July 16th, 2021, 25.73 years of service with reciprocity. And Bradley Ross Miller, police officer, police department, effective June 21st, 2021, with 16.98 years of service. Do I have a motion to approve that?
So moved by Muyo.
Moved by Muyo. Do I have a second?
Santos.
Second by Santos. Going around the block. Andrew.
Aye.
Sunita.
Aye.
Howard.
Yes.
Far.
Aye.
Joe.
Aye.
Yes.
Santos. And Sanzeri. So can't hear you, Vince. It's fine. This Chair Lanza. I vote aye as well. We've got a long list of deaths. I'm going to read these off, and we'll have a moment or two of silence. A notification of the death of Douglas Biddle, fire engineer, retired January 5th, 2019, died March 13, 2021. Survivorship benefits to Samuel Biddle, son, and Pearl Biddle, daughter. Notification of the death of James C. Foley, fire engineer, retired September 12th, 1992, died April 6, 2021. Survivorship benefits to Linda Moore, spouse. Death of Russell Hewitt, fire captain, retired October 7, 1987, died April 25th, 2021, no survivorship benefits. Fred Kingsley, police sergeant, retired February 5th, 1998, died April 12th, 2021. Survivorship benefits to Shirley Kingsley's spouse. Death of Wilbur Mitchell, police sergeant, retired June 3rd, 1993, died April 29th, 2021. Survivorship benefits to Carol Mitchell, spouse. Floyd Stewart, fire captain, retired September 1st, 2010, died July 1st, 2020, no survivorship benefits. And the death of Gerald V. Van Horn, firefighter, retired November 9, 2000, died April 6, 2021. Survivorship benefits to Joanna Van Horn, spouse. Will now have a moment of silence. I don't know, Dick, Nick, Andrew, anything about the living or the deceased you guys want to weigh in?
This is Dick Santos. I do want to take the time to weigh in because every one of those firefighters I worked with for all my years on. And the one I want to make a note of was on Doug Stewart because he had 40 years. There was a misprint. But the issue was that he was the trustee also in Local 230. But they'll all be missed. Excellent workers and the best of their families. Thank you.
Anything for Andrew, Nick?
Yeah, I'll go ahead and go. In regards to the people that are retiring, I've worked with all three gentlemen, great people, great attitudes to the department and to the community, and I hope they enjoy their retirements well deserved. In regards to those that unfortunately have passed away, Dick touched base on Kevin Stewart. He spent 40 years, pretty much all of them downtown at the busiest station. The only reason he retired because he aged out. There was an age limit in the department, so that was the only reason he retired. And so appreciate the service. And then to mention on Mr. Biddle, who passed away recently. He just retired a year and a half ago, and has a young family, and condolences to him, to his family, kids, and everybody else that has passed away. We appreciate your service. Thank you.
Sandra, anything from you, Nick, on the police side?
Yeah, thanks. With regard to the the retirements, a lot of 25s walking out the door as soon as they're able. And my condolences to our fire friends. That's a long list this month, and I know it. I know it hits home for Andrew and for Dick. Briefly on Sergeant Mitchell and Sergeant Kingsley. Sergeant Mitchell worked in our pre-processing center, which San Jose, we make a lot of arrests, so we have our own processing center where we take felons for prints and photographs before we take them over and book them in the county. Large man, gentle soul, but if you came into the pre-processing center thinking that you weren't going to go along with the program, one look at Sergeant Mitchell kind of made you rethink your thoughts there for a while. And I had the pleasure of working with Fred. Fred and I were on the same team. I worked for him. We were having coffee at the downtown Holiday Inn the afternoon that one of our teammates, Henry Bunch, was shot and killed in the drunk trailer after making a drunk arrest and getting in a fight with a suspect in the Deuce trailer. So my condolences to both of their families as well. Thank you, Drew.
Thanks, Nick. Let's move on to the committee reports. Anything to report, Ashfar, on the investment committee?
Nothing to report. We did not have a meeting last month. So.
Great, thanks. Howard, I see we've got some stuff here on the audit risk committee. Do you want to give an oral update? And then it looks like item 7.2E, there's action, whether you want to do that or Roberto. Go ahead, Howard.
Right. Yeah, thank you, Chairman Lanza. We had a meeting of the Joint Audit and Risk Committee with Federated on May 20th. The principal item that we discussed was the committee's approval to recommend and approval to the Grant Thornton audit plan for fiscal year 2021, 2020-2021, including the timeline and scope and deliverables. The actual plan, as you indicated, is in section 7.2E. And if there are any questions, we can discuss that if you've reviewed the plan by Grant Thornton.
Howard, you can go ahead and make the motion to approve it.
Okay. Are there any questions for either me or Roberto on the Grant Thornton audit plan?
Pretty straight.
Okay. Is there a motion to approve the recommendation by the committee for the?
You can go ahead and make the motion, Howard. I'll second.
Okay, great. I'll make the motion to approve.
I'll make the second. I chaired that committee for many years. Let's go around the clock. Andrew.
Aye.
Anita.
Aye.
Howard.
Yes.
Ashfar.
Yes.
Nick.
Aye.
Santos.
Yes.
Vince.
Aye.
Oh, hey, Vince, thanks. And Mr. Chair Lanza, I vote aye as well. Let me note for the record that we receive and file the minutes of the February 18th joint meeting and our meeting. We receive and file the quarterly travel and attendance report, and we receive and file the update on the city auditor's recommendations. Anything on governance, Nick?
I can tell you, Chair Lanza, that the next meeting is after Federated this month, June 17th.
Oh, good. Thank you. Dick, anything from disability? I know we've got a meeting this Monday.
We have a meeting Monday at 10 o'clock. We'll see you there. We'll be saying goodbye to Dr. Timmer. So see you there.
Thank you much. Finally, you, Vince, anything on the JPC?
No, we have not had a meeting since our last one in April, so nothing to report out there.
Well, let me just say to the board that wraps it up. I sit on boards for a living. This is a spectacular board. That's really hard to go through a 4 or 5 hour Zoom meeting. You've all just been great. Anyway, everybody have a good weekend, and we'll see you in August.
Thank you, everyone. Enjoy your summer. Thank you very much for a great job.
Thank you.
To staff. Take care, Roberto.
Thank you. Bye.